We still think rates are somewhat too high over the long run.
As long as the politics lets the U.S. be exceptional, you can have higher yields and a stronger dollar.
Turning to the U.S., we are a lot weaker than consensus with U.S. growth.
Inflation expectations are fairly well behaved for consumers.
What we're seeing is the lagged impact of fairly aggressive monetary tightening really starting to bite.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Live from the City of London for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Your equity market bouncing back from the biggest one-day loss since March. Equities this morning positive by 0.26%. Big change in the last couple of days. Cycle highs at the front end, on the long end. TK, those yields starting to bite into risk assets.
They really are. There's really been a game change in the last 48 hours, maybe take it up to 72 hours. I get the idea there's a reprieve today. I got a red cup here, John. On radio, you can't see it. I've got the Bloomberg red cup China because gloom is in the air, and you see it in the yield space. And frankly, John, foreign exchange is becoming interesting.
Treasuries down, yields higher, equities punished in yesterday's session. Bramo finally starting to respond to what we've been seeing developing in the bond market for the last couple of months.
Suddenly there's this idea that maybe higher borrowing costs are going to be problematic for corporations and for individuals. And it's raising a question, are we truly reaching a breaking point, or is this just a digestional pause that typically happens around this time of year? It is unclear. At this point, though, it seems like there has been a game changer, a sea change in the past week where people are looking at higher for longer. And the implications of that are less benign. Different implications in different places. In America, jobless claims yesterday, 201,000. The data this morning in Europe, absolutely terrible. Steve Englander of Standard Chartered saying this about the Fed. We see the Fed as somewhat mystified by the resilience of the economy. Yeah. Resilience in America off the back of these moving yields. I'm not sure you can say the same thing about Europe, Tom. You certainly can't say the same thing about the UK.
Yeah, I counsel people that don't look at the foreign exchange market to start making a study of it because it's really interesting, John. I don't believe we can leave London until sterling prints a 119. I mean,
you want to hang out until then?
You're going to hang out. And,
he just wants to hang out.
Well, yeah, well, maybe quickly. You know, we may get there by, early October. 122.42.
106.39 on the euro. We close here 10 consecutive weeks of euro weakness against the dollar. Bramo, that is a record streak of dollar strength, euro weakness. So this is the question, and you really laid it out well, which is that the strength that we're seeing in the U.S. is exemplified by jobless claims was anything but what we saw in the PMIs and some of the data that came out of Europe this morning. France saw its biggest decline in activity going back 3 years. You can see on the margins, Germany is doing marginally better than expected, but across the board, it looks like a recession. And in the U.S., the question is, why isn't it? Why is it not weaker? Why has something not broken with the fact that rates have gone up 5 percentage points in the past 18 months?
First of all, half of America feels like they're in a recession. On a societal basis, there's a lot of people really struggling in America. But the answer is, as Ned Phelps, a lawyer at Columbia, would say, it is the unique dynamism and the ability on a Hayekian basis to clear the markets in America. That doesn't happen in Germany.
Things did break. We just moved on pretty quickly. The banking system broke, didn't it?
For a second.
Some banks failed. I never thought in that moment that maybe cycle highs on yields would be in our future. But here we are 6 months later, looking at a 2-year, pushing 520 this week. A 10-year, briefly through 450. These are changes people didn't foresee 6 months ago. One of our guests yesterday said it's become pretty clear that no central banker, no policymaker is going to let a major institution fail in some sort of systematic way. And this raises a question, okay, well, if it doesn't, then any kind of snafu or something breaking is quickly going to be covered up and fixed so that it doesn't actually have a material tightening on the market, which really raises a question, what will it take? If this is just a level that we can live with, at what point do people start questioning, well, who's going to pay an 8% mortgage? Who's going to pay an average 6% on an average investment-grade corporate bond after paying 2 or 3% over the previous decade?
Gloom within the shadow of St. Paul's Cathedral. What we're going to do today is we've got some great conversations for you here to get set up for the weekend. And quite frankly, John, my head's already into October on the way to the November Fed meeting. The jobs report we'll have for you, I believe it's next Friday. I'm going to guess on that. But the real issue is we have to leave town because of the Ferro Tot frenzy. We go to Tom Barkley in the Sun newspaper writing up the storm. We've got to talk about this, John, right now. We'll feature this through the show today. Would you explain to our economics, finance, investment, and international relations audience why 47 people, including ESPN Santiago, Chile, picked up your chit-chat with Mr. Levy of the Tots.
Daniel Levy, longest-serving chairman in English football, the top-flight English football in the Premier League. Barely talks, barely does interviews. I can't think of the last time he's done a broadcast interview. We did one earlier this week. He's open to a stake sale, Tom. Open in a way that I think a lot of people sensed he hasn't been for a long, long time. I'd encourage other people to go and listen to the conversation themselves to see what they take away from it. They lost one of their big strikers in the summer. They've done a lot to improve the sustainability of the club with the stadium.
It's fun to watch.
They're bringing in tons of money from that stadium. And maybe, Tom, we're looking at the prospect of new ownership. I'm not saying that's going to happen anytime soon, but that's where the conversation is.
I know we got to get the show going, but I got an email from Luke Kawa over at UBS, and he said, wow, they sound like the Toronto Maple Leafs. They haven't won since time began. And he said it at the end. I was shocked at the end of the interview. I mean, I'm not going to go to the Arsenal Tots game now. I was so upset with Mr. Levy, where he said, we're here to entertain people. I was thunderstruck by that statement.
He wants to win, but win with style. Win with style was that final line.
We call that doing the Toronto
in that
Maple
conversation.
Leafs.
Let's turn to the price action. Thanks for the wonderful feedback for that conversation. I really do appreciate it. Equities on the S&P 500 positive by 0.23% on the S&P. Yields a little bit lower, Lisa, down a basis point, but still here we are. Through 450 briefly, 447.83.
So if you wanted some insight on what's going on in the bond market, you're in luck. Fed speak returns. Today we get Fed Governor Lisa Cook speaking at 8:50 a.m. Eastern Time. San Francisco Fed President Mary Daly and Minneapolis Fed President Neil Kashkari both speaking at 1 p.m. So you can get all the insights and the translations that you want of how long this economy can last with rates where they are. 9:45 a.m. We've already gotten PMIs from Europe, from France, from Germany. We now get them from S&P Manufacturing Services and manufacturing for the United States. That comes at 9:45 a.m. and at 10 a.m. This is also going to be really important. How long are these strikes going to go on in Detroit? The United Auto Workers are having a Facebook Live event in Detroit. Maybe we'll find out if they're going to expand some of their actions at specific plants. They'll talk, maybe I'll give a little more insight about what's been offered and what the request is, the ask, because it really is unclear, John.
The deadline is midday today, but the Facebook Live event is 2 hours before.
That seems to be
kind
a trend.
of what they did last time around, wasn't it?
Signaling before the final.
Okay. It's one to watch a little bit later this morning. Jonathan Stubbs with us around the table here in London, equity strategist over at Berenberg. Jonathan, welcome. Good morning to you.
Morning.
Higher for longer. Let's go one step further. Is this the new normal, or dare I say the old normal? Can we live with rates where they are at the moment for maybe a whole cycle?
Well, we've gone back to spreads. You take sort of US credit against equity spreads. We've just gone back to the pre-financial crisis level. You've missed out of 10, 15 years in between. If you're sleeping, we're back to that. Can we live with this? It's a big transition for individuals, for corporates, for governments who have had free money and access to free money for over a decade. So I think that the transition is going to be challenging, and to digest higher rates for longer will take time and presents many headwinds, and we need to find some tailwinds to counter that, and they're not quite so easy to see right now.
What is a tailwind that pushes against a real yield, the 10-year U.S. real yield? Huge move this week through 2% out to 2.11%. I don't have a good print yet this morning, but the basic idea here is there have to be these things, these institutional forces that push against that new real yield reality. What are they?
Well, we need liquidity, fiscal, corporate profits. One of the three, all of the three. And liquidity, to get a liquidity support for equities, and we monitor dollar liquidity around the world. There are only sort of three ways of getting that, and one is a very weak dollar, a dollar shock negative.
That's working out right now.
That's not really happening. The second is having a liquidity surge coming out of a major economic bloc, US, China, Europe. You need system risk for that. That's not on the cards imminently. Or you need a global recession. So the liquidity channel is challenged. Fiscal we're seeing some of, but you need a delta fiscal surge from here. Not going to happen. And then you talk about profits, and that's also challenging in discussion right now. So it's quite hard.
Yeah, but your claim for partitioning on sector basis, and I would suggest, and I don't want to go, it's too much theory for a Friday, but the answer is there are going to be haves and have-nots within a new higher real yield environment. Can you invest in the haves and ignore the have-nots crushed by real yields, or do you sort of have to walk away from the market in entirety?
Well, we've been taking a more cautious approach over the last couple of months. So I got sort of active hedging. We've been sort of pushing energy quite heavily because it's a sector which has balance sheet strength, that has cash flow. The macro has obviously come on its side more recently as well. So we're in that mindset. In terms of the haves and have-nots, the pricing gap in the US between the haves and have-nots, and you measure this by looking at the interquartile range on a PE basis, that gap is as high today as it was at the peak in 2000. So the market is already pricing that today, and that's at historic highs. So to go and buy that haves and have-not trade today, it's already been priced in. So we would rather lean on valuation, and we see tech super expensive, US defensive super cheap. We see some softening of growth, and we're inclined to lean into that by taking some out of tech and putting some into the cheaper parts of the market.
Which is something that Jim Bianco was talking about at Bianco Research overnight, basically saying that it's been led by the Magnificent Seven. Everything else has kind of tumbled along in pretty short order. U.S. equities look stretched, expensive, and narrow. These are your words. How much of a sell-off, particularly in big tech, do you need to see before it doesn't look expensive anymore? Well,
the big stocks in the US, the top 10 have added $4.5 trillion this year on its own, which is quite remarkable. That's bigger than the Nikkei 225 as an entire index. So we've seen phenomenal sort of narrowness in the US market. Take those stocks away, the US has done the same as Europe and the UK. So nothing's really happened in equities ex-Japan, which has been on fire, outside those very, very strong stocks. So if we're not going to find fresh energy for that leadership, it becomes a bit of a struggle, and this is why we're leaning on these valuation gaps. Is why defensives in the US actually look quite interesting right now to us, and that's how we'd sort of start allocating.
Can we make an equity call off the back of FX market dynamics at the moment? Can you make an equity call?
100%. I mean, the big dollar call post GFC was the dollar was strong. What that meant is it took away nominal growth from the rest of the world. So global growth had a sort of 10-year period where we had a growth deficit post GFC, partly because of the dollar. In that period, equity growth outperformed. So the dollar is critical here. The dollar has been strong over the last few months, but over the next 2-3 years, is it going to be a strong or weak currency? I think we're seeing a changing balance of risk in the US. Political risk is much higher than it was over the last 15 years. Economic risk, look at the fiscal position, and look at the banking sector as well. We have some fragilities there. So I think it's harder to make a case for a very strong dollar unless Europe or China goes into this sort of persistent slump. Also quite a hard base case. So there's some medium-term support for rest of world, but near-term it's quite tricky.
So for those getting excited about sterling weaker, go along the FTSE, what would you say back to them this morning? Fade that?
Well, the UK's an interesting market because the macro is not great, but the market's trading on 10 times, right? So it's got some valuation protection. Balance sheets are strong. The big valuation sort of trade or gap in the UK is actually between the 250 and the 100. The 250 is hitting some historical valuation levels relative to the 100. So the 250 is super cheap. It lacks liquidity. It lacks liquidity because there's no macro confidence. Into next year, as macro improves, liquidity comes back, UK mid-caps look very interesting at this point.
Interesting. Jonathan, thank you. Jonathan Stubbs of Berenberg on the equity market, not just European equity market, but worldwide, the US as well. Equity futures this morning, if you are just tuning in, equities trying to bounce here by 0.2%. We are coming off the biggest day loss going all the way back to March. Remember the banking crisis? Didn't last too long, did it? Yes, 6 months ago. Yields lower by about a basis point, backing away from those cycle highs, Tom, in the last 24 hours. 447.83.
Just got a good print on the 10-year real yield. It rounded up to 2.10%. This is an 80 basis point moonshot. Real strength to it coming out of May of the early summer. At 2.10, John, is the stunning statistic of our visit here to London. I can't say enough how game-changing that is. And it's got some accelerative tendency to it, what's called log convexity. Where is it in a week? Where is it in a month? The trend is higher.
It's amazing to see. The conversation continues. Next hour, Dan Morris of BNP Paribas Asset Management. Live from London, equities trying to bounce. This is Bloomberg.
we've got to have these negotiations play out, and the outcome, and this is what I said in Detroit last week, that outcome has got to be a good deal for the workers. You're not going to see a contract signed that doesn't deal them in properly. That has got to be around the 4-year plan to increase wages, getting rid of tiers, reestablishing pensions, and also points are being made across the board that I think the American people are hearing.
Representative Eddie Stevens, Democrat from Michigan, speaking on balance of power with Bloomberg's Anne-Marie Hordern and Joe Matthew. We'll catch up with AMH in the next hour. If you are just joining us, big moves in the last week or so in this bond market, major moves in the Treasury market, yields we haven't seen for a long, long time.
Long time.
A 10-year through 450 briefly. Yields coming back in about a basis point, 447.83 on a 10-year, a 2-year in the last couple of days, pushing 520. Just absolutely unbelievable to see the 10-year, the highest since 2007. I do want to breathe some life into the FX conversation just a little bit. The euro now is heading towards potentially a 10th consecutive week of weakness against the US dollar, which is phenomenal. On a weekly basis, that is a record losing streak. The euro right now negative by 0.1%. Lisa mentioned this about 15 minutes ago. I think it's worth going over again. The PMIs in Europe are dreadful. So if you hear some similarities between maybe some of the guidance you get from the Federal Reserve, high for longer, maybe we're done. The Bank of England, high for longer, maybe we're done. The ECB, high for longer, maybe we're done. That's where it ends. Compare and contrast the economies at the moment. Jobless claims in the US, rock solid, 201K this week. Compare that to the PMIs in Europe this morning, Lisa. Absolutely dreadful.
And I'm looking at the surprise indexes in both areas, and you can see it's solidly positive in the U.S., albeit bouncing around, and solidly negative in Europe. And this is really the question. How come the U.S. is so much more immune to high rates, and how long can it stay that way?
It's early. Some people, I think, would say early innings. That's baseball talk, John.
Thanks for that, TK.
But, you know, I take the point, but I really wonder if it's just getting started. These levels are shocking that we're at right now. Anne-Marie Hordern and Joe Matthew know how to pick them, and they really picked the right person with Congresswoman Stevens from Detroit. Wendy Schiller joins now with some historical perspective on many topics, the shutdown, and certainly what's going on with Detroit and Providence at Brown University. I thought that interview last night, I was in my hotel room, early to bed, early to rise, Professor Schiller, and I was thunderstruck to hear the voice of Detroit yearn for a Detroit from another time. In Washington, are our politicians looking at the UAW strike as a strike of the present and indeed our manufacturing future, or are they and the president stuck in Congresswoman Stevens' past? Are they stuck in a Royal Oak, Michigan, where auto workers made $120,000 or $150,000 a year?
Well, I mean, I think politically, they have to live in the present. And in the present, the Democratic Party is closely aligned with labor. And we have strikes across the country, right? We still have SAG-AFTRA. We have hotel strikes in California, for example. You know, a little bit of strike fever is kind of coming to fruition right now. And when people get concessions, when labor unions get concessions, other industries, other labor unions say, wait, maybe we should do that too, or we can do that. It's not a frivolous decision, but it's a strategic decision. And I think right now the Democrats have no choice but to go all in, even though there are very significant ramifications for them on the economy, obviously. We don't know how far it will spread outside the Rust Belt, but on environmental, on climate change. If you're going to go all in on electric cars, which the big three seem to be doing and Joe Biden is doing, you have to pay political consequences with the workers in unions that are worried about those kinds of changes.
Right. That's exactly where I wanted to go. We are seeing in real time, folks, for those not up to speed on the London Ballet, besides John Farrow's Tottenham interview, the answer is there's a raging debate in this nation about the broader ESG. Is that going to trip up the Democrats like it's tripping up the conservatives and indeed some of labor here in the United Kingdom?
Tom, I think this is a fantastic point, and I do think it's an electoral vulnerability for the Democrats. This is the problem with having highly educated people who really worry about climate change but do not work in a labor industry like autos, and a lot, meaning thousands and thousands of auto workers in key swing states that do depend on that industry for their livelihood in the same party. in the same political party. How you meet the needs of both of those major constituencies going to 24 is testing right now, today, when we think about where the Democrats are going to come down on this strike and how long it goes and whether there's additional economic pain outside the auto industry and outside the Rust Belt states.
So this is splintering the Democrats. At the same time, we are seeing a splintering in the Republicans around the government shutdown with rebellion, as some people are calling it, against House Speaker Kevin McCarthy. President Biden is viewing this as an opportunity. It seems like his team thinks this is going to be beneficial to him. He tweeted out over the weekend, or X'd out, last time there was a government shutdown, 800,000 Americans were furloughed or worked without pay, but enjoy your weekend. Do you really think this is going to be a benefit if the government shuts down to the current president?
Lisa, I don't think a shutdown is ever a benefit, but it does happen to be the case that most of the time, not always, the president wins on this, or when you're a Democrat, give or take, or Trump, who won for a little while and then caved the last time there was a shutdown. The big counterexample to that is 2013, a very long shutdown under Obama administration, and the Democrats lost the Senate in 2014. It's the most expensive political shutdown for the Democrats, and the Republicans shut the government down. So the people who are leading the charge on the Senate side, Ted Cruz, people like that, but the newbies in the House, they know that they may not pay a political price for this shutdown because Republicans in 2013 really shut it down for a long time and did well. So the jury is out. Most of the time, the executive branch wins because government fails. It doesn't work anymore, and constituents are harmed by that, and they get in touch with their local congressional office when they are upset about a shutdown. They don't reach the White House. So in that sense, I think Republicans can do this, but they can't do it indefinitely, and that's what Biden's trying to wait out.
It's very difficult when I read this to suppress my frustration because I feel like we were just here not that long ago. And the more that I read about the mechanics of this, it doesn't seem like we're getting any resolution anytime soon. Wendy, how long could this potential shutdown last if it does go according to how it looks right now?
Well, there are two scenarios, I think, right now that we're looking at. One is that the shutdown, lasts a little while and then people come to the table and they resolve it because, there are probably 150 votes in the Republican Party that want to see the government stay open, that do not want a shutdown. And, the margin for the House majority is very slim, and the seats that are important to them are in California and New York. So, that's a problem for the Republican Party. Kevin McCarthy, on the other hand, doesn't play this right, could be subject to a sort of oust the speaker movement. And if that happens, then we have chaos. Then the shutdown could last a lot longer. And that's the nightmare scenario. And even if Biden wants a political discord, he doesn't want a functioning government collapse. So I think that's the problem for the Biden administration. They don't want to undermine McCarthy so much that he collapses, because then we have chaos.
Just very quickly here, Professor Schiller, the obvious southern rest of the country is a generalization, partition of Republicans. How in God's name do they hold a convention next summer? I mean, how do you get them all into a coliseum? The gentleman from Arkansas gives 6 votes to Jonathan Ferro. The Republican discord right now is how do you get to a convention?
Well, you don't have to have a convention, right? That's a convention, a traditional thing that parties do, but you don't really have to have an in-person convention anymore. Politics has changed so much, Tom, that it's unclear that they won't throw the whole thing out. If Trump looks like the dominant candidate and he's already winning, massively by March, they might just, virtually declare him the winner. They don't even have to go to Milwaukee. They're going to Milwaukee because they need Wisconsin, right? But generally speaking, they don't have to do anything anymore. So all of us who are looking for these normal, traditional party practices with Trump at the helm, I don't think anybody should be betting on anything that we used to do.
It's so true. There's a debate in 5 days. Hardly talking about it. Former president's not going to be there.
Yeah. It's
the way it is.
It's the way it is.
Wendy Schiller, thank you. Wendy Schiller of Brown University. Shutdown talk. I cannot think of a single story that I get frustrated more about. I wake up every morning, you see the latest on it. I do not want to click on it. I don't want to read it. I don't want to open the email. I don't want to read the research on it. I don't even know where we are on it.
I know. Well, I can tell you that we're less than 10 days out. And Libby Cantrell thinks at this time that maybe markets will wake up at PIMCO.
Can you imagine Milwaukee, the surveillance set with AMH and Joe Matthew? Can you imagine at the Pabst Blue Ribbon factory?
With cheese heads.
With CBRs, I mean, that's why you go to Milwaukee.
What's this bit, though?
That's the Pabst Blue Ribbon Museum.
Okay.
They've got like a whole thing there.
That's what that means.
Jordan Rochester, Nomura, up next. Heading towards a third week of losses on the S&P 500, trying to bounce. It's not too bad this morning. It's a little bit better compared to yesterday. Equity futures positive here by 0.2% on the S&P 500. On the Nasdaq, we're up by 0.4%. On the S&P, potentially the worst week since March, after the biggest one-day loss in 6 months on the S&P 500. And your why is in the bond market, as it often is. 2-year, 10-year, 30-year, 2-year this week, pushing 520. 10-year briefly today, going through 450. Yields back in a couple of basis points, Tom. 447.63 on a 10-year.
These are just when they correlate over to everything else, including the equity market, over into commodities. I mean, Brent's taking a breather here. I thought Ed Morse was just fascinating about how he reaffirmed a lower oil price with Lisa the other day. But, you know, I'm going to go when there's tension like this, whatever the tension is you have this weekend, whether you're a student or not, John, you got to look to the foreign exchange market. I mean, that's the deepest market. That's the litmus paper.
So yields up, stocks down, dollar stronger. Here's a snapshot of foreign exchange at the moment. Let's just pick on the euro. The euro at the moment, 106.38. Not a big move today. We're negative 0.2%, but we are heading towards, poised for, a 10th consecutive week of euro weakness. And the data just not happen, of course, Lisa, on either side of the Atlantic. In the US, strong, decent. In Europe, not so strong, not so decent.
And it is a U.S. story. It is both sides, but it's also a U.S. story because you could see DXY going to the highest levels, the strongest levels, bumping up against there in almost a year. Right. So you can see that it's broader than just a European story. Everywhere else seems to be seeing weakness, as the U.S. is sort of, we're doing great. We don't see the problem.
Under surveillance this morning, let's talk about those central bank decisions. 3 holds across the board for major central banks this week. The BOJ, haven't talked about it yet, joining the BOE and the Fed, leaving rates unchanged. Governor Ueda saying future rate hike speculation because we aren't in a state where inflation accompanied by wage growth, sustainable and stable inflation is in sight. We're patiently continuing with monetary easing under the current framework. So, Bramo, no change there at all.
Even though just a little bit before they put out that statement, CPI in Japan came out hotter than expected at 3.2% versus the expected 3% year over year. So at a certain point, it is creeping higher.
Exactly.
They also have the yen that is getting weaker, the imported inflation. They say it's almost reached a peak. Okay. Well, at a certain point, nobody believes him anymore. Is this going to be a massive credibility issue as people still game out intervention?
We'll sit on this with our guests. We can do an entire discussion here on what Bank of Japan is. What I notice is the meeting comes out here in London. I can't remember what time it is. I'm like, wow, they're coming out. And then I see that Formula One this weekend in Tokyo starts at like 11 p.m. or 1 a.m. in the morning. What's that about?
I was watching some of the times of Max Verstappen. He's absolutely crushing it, right?
Coming back from Singapore.
Yeah,
let's move on.
I'm sure last weekend hurt.
Oh, yeah.
I'm sure that hurt. I'm expecting a dominant effort from Verstappen this weekend. President Biden pledging more aid to the Ukraine after meeting with President Volodymyr Zelensky. The $325 million aid package comes from funds already approved by Congress. However, more funding to Ukraine is becoming a sticking point as Speaker McCarthy looks to strike a deal to avoid a government shutdown. Lawmakers are leaving town for the weekend as the September 30th deadline approaches. If I sound frustrated, it's because I generally am. This story drives me nuts.
Which aspect of it? The questions over funding for Ukraine?
We're always doing it all the time.
Yeah, that we're always shutting down.
You know?
That it's being held as a political football. The idea that, 800,000 people have to get paid. The idea that we might not get economic data to really discuss and parse through. I mean, this is actually a real concern for a lot of people, particularly the Federal Reserve. If they're data dependent and they don't get data, what do?
Got a great guest around the table with us, so let's finish up with this, Bramo. Rupert Murdoch stepping down as chairman of Fox and News Corp. His son, Lachlan Murdoch, will take over as head of the media empire. The elder Murdoch isn't leaving completely. He will serve as chairman emeritus of both companies. So is that Kendall Roy out, Tom Roman gets the job? Is that what that is?
Yeah, I don't know the politics of it. I've got a nodding acquaintance.
Did you watch Succession?
Young James. No, I didn't.
Okay, so that was lost on you.
10 minutes.
All right.
I watched where they called me up and they said, you're on it. And it was like, the TV 6 rooms back. And, I had
I think you did make an appearance, yeah.
Yeah, I made it in billions, too. It was just great. And, I'm sure all of surveillance did as well as we deserve to.
Promo's in billions.
The answer is, okay, there it is. And can we just stop and say this is maybe the transaction of modern financial history. I'm Rupert Murdoch, and I want to jettison this dog to Disney for $70 billion plus. Transaction of our lifetime.
I think it's also interesting because it is like Succession, and Lachlan is getting it for now. But when Rupert passes on, there's a real question about the rest of the family, especially because they disagree with the politics, right? James has actually come out and been really pretty adamant in his claims against it. So it raises a question at a time where it's been stripped back to just news and sports. And so the news part of it's going to be kind of interesting.
Did you watch Succession?
I did not.
I'm so alone here. I can't believe... OK.
I
right.
would
I don't
like
watch anything.
OK. They're your stories under surveillance. Thanks, guys.
Joining us right now with the most important interview of the day, because when it's like this, you triangulate to foreign exchange. Jordan Rochester is G10 FX strategist at Nomura. I got one basic question. I'm told I can't get back on the plane and go back to New York unless I get a 119 print on sterling. How quick is Prime Minister Sunak going to get me to a 119 sterling?
That's something that could happen before year end. The moves aren't as rock and roll as last year, though. We haven't got a Liz Truss versus a lettuce moment right now to kind of get you that move lower. But we were at 118 in March earlier this year. So it's very possible that 119 we could be talking in the next 6 weeks.
Euro, parity call, earlier this week on this programme. Jane Foley, Rabobank, she said maybe. Where are you on that now?
I was going to say, is that the call? It's definitely a maybe, but that requires your next guest to tell us about oil, Christian. Alex. So if oil goes to 100, OK, we get to 105, maybe 104 in euro. But to get down to parity, we need that energy squeeze that will hit that trade balance. Because what's happened? The euro area's got a lovely current account surplus once again, thanks to lower natural gas. So we need a cold weather forecast for October.
So things need to go wrong in Europe. We've done enough on the US side. That's not where the surprise comes from for you.
I think so. The US, in the next two CPI prints, what's going to be interesting is oil's up 7% this month, but gasoline futures are down. So we're not going to get a really hot CPI print on headline like we got for last month. We got 0.6 month on month. The next month could just be 0.2 for headline. But if gasoline futures were to spike back, we get another hot CPI for the US, followed by another one if oil goes to 100. Then you could be talking parity in euro from a US perspective.
In general, when we talk about dollar strength right now, is it a dollar story or is it an everything else story being weak?
Oh, it's both, Lisa. So the dollar's strong because we've had a basically reinflation. We've had not just energy prices going back up, but these UAW strikes were interesting seeing some signals that car inflation could come back. So it's really hard for the market to look for a dovish Fed right now, especially with continuing claims falling lower once again. So we're not seeing any material job layoffs in the US. And then that's the US side. In Europe, it's horrendous in terms of growth. Look at the UK services PMI. We had one of the biggest falls in the employment index within that PMI today. So it's quite clear that unemployment's rising in the UK, and we're seeing softness in German labour market data as well. So to answer your question, it's always both because it's currencies. We always do both. The European data for growth and for employment is looking pretty shaky.
What's the level of strength for the dollar where it becomes truly disruptive?
Well, in terms of the disruption, we're already getting close to those levels. As John said, parity in euro, that would be a disruptive level for sure.
Oil. I want to talk a little bit more about crude and the move we've seen. You said that maybe if something goes wrong with gas, what about Brent and WTI? What about that? We're already in the 90s on Brent. Doesn't that change things for Europe?
It already has. It already has. That's why I think the first half of this year when energy was weak, I thought that we could see euro finish the year higher. But that's completely changed. I didn't expect Brent to go above 90.
Well, you changed from 115 to 105 on the euro, right?
Yeah,
in the last
because of that
months.
Brent move, for sure. And we had this horrible range. So macro PMs have had a really tough first half to the year because euro's been in a yo-yo. And everyone gets excited at the highs, excited at the lows, gets stopped out chasing their tail. I think we're going to see a proper breakout. FX has lacked a trend in the dollar this year. We're now getting a trend thanks to the energy story. So last year was thanks to Vladimir Putin. We got a big trend in the euro. This year, it's thanks to MBS in Saudi Arabia.
Why isn't the yen weaker today?
Well, because you haven't had a hawkish move from the Bank of Japan. What's quite interesting is we thought the forward guidance would change. The forward guidance still says potential additional easing could be used. So that was a bit odd, given we thought Ueda had shifted a little bit more hawkish with his article from about 2 weeks ago. And then the main problem for dollar yen is it's quite easy to say cost of carry is very expensive to be long the yen, so therefore don't buy it. But you've got the Ministry of Finance threatening FX intervention risk. And we've even had softer words from US Treasury Secretary Yellen about maybe Japan can intervene. She hasn't said it that exclusively, but she's definitely softened her tone.
So in other words, we can take a look at the yen and just say that nobody wants to bet against the central bank and nobody wants to bet against foreign intervention, that they're likely to deploy. But it has nothing to do with the differential at this point between the monetary policies.
Oh, it absolutely has everything to do with the differential. And if the MOF threat of intervention wasn't there, we would be closer to 150 right now. If the idea of the BOJ turning hawkish wasn't there, we'd be closer to 150. But because of that threat, people are being reluctant to get into that trade. But if you were to look at the cost to carry, it's even higher than what it was last year when we were at these exact same levels. But Lisa, it's deja vu. I was in September, New York. In New York hours, the Ministry of Finance came in and intervened at dollar yen around 150. It feels a bit like deja vu, so people are just a bit reluctant here.
You and I are on the same page. First thing in the morning I do is I look at Swissy franc, different pairs to 4 decimal points to just see when is Swiss franc in a signal strength. You say Switzerland stocky is a play, CHF, SEK, Swissy stocky is a trade to play here for long Swiss franc. Why will the Swiss franc strengthen? Let's start with that.
Yeah, absolutely. So we always have our main dollar views, our sterling views, but then you have to talk about RV. And what we're talking about here, Tom, is long Switzerland, short Sweden. Now, Switzerland has seen massive appreciation of its currency over the past year,
right.
But I think that's a trend that carries on. We're going through a period of an adjustment for Switzerland. Last year, before they started raising rates, it was negative 75 basis points. We're now around the 150, 175 on the front end. So you're getting paid for holding Swiss in the bank account, where last year you were being charged. We've known that for a while, but we're still going through an adjustment phase. And the banking repatriation flows back into Switzerland, those Swiss banks were lending to American corporates, European corporates. They're not going to do that next year because they've got nice yields at home. So we're seeing a lot of that money come back into Swiss, boosting the currency. And the second reason is when growth slows down, you go long the Swiss.
Okay, I'll go with that, except the SMB to me is almost a sovereign wealth fund with the equity ownership they have, and particularly the load-to-boat position on Apple as well. Does their equity stub within the central bank, does that preclude usual strong Swiss dynamics?
I think the SMB is just taking the view that we're happy to take a loss on our FX reserves. And in fact, what they're doing is they're selling their foreign holdings as well. So they're actually consistent sellers of, they're 80% bonds, 20% in equities. Right. So the largest part will be in the fixed income space. Right. But we've seen 11 billion of intervention per month from the Swiss.
Give me a level on Euro Swissy, the core pair there to watch, 0.95, 0.94?
It's easier to trade this Swiss stocky than Euro Swiss. Euro Swiss, I've actually stayed out of it. It's one of the most non-macro currency pairs in the G10.
Euro Swiss, Swissy stocky. It's the most London thing I've heard all week.
Well, you know, I mean, it's romantic. We got to bring these people in. I mean, they're all dazzled by your interview with Daniel Levy, and I got Jordan Rochester here, and you know, we got to bring our FX people in. They stopped me. You know, a guy stopped me today. They watch in Singapore every evening.
That's very cool.
And they watch me, and they're popping FX trades in Singapore off what we're blathering about. So I got to go to Rochester here to get some romance in it.
Can we just finish on that?
I'm going over to Mayfair and look at a Ferrari.
So that's Sweden versus Switzerland. On the Swiss side, that haven currency on that growth slowdown, you think money's going to go back there. Who else is in that bucket? Because it used to be Japan. What else is there?
Good question.
Yeah, it is euro. That's kind of why the euro hasn't been rock and roll. So you're asking about the 105 down to parity view. We've got better trades to do. Short sterling versus the dollar is a better trade. The way we're playing euro is short euro versus CAD. But the reason I mention euro is because we are having banking repatriation. For a long time, German banks, French banks had negative interest rates. American corporates asking for money, let's go for it. Let's lend abroad. That's now reversing because they've got positive yields at home.
Do you have a level on DXY where you go, OMG, you wake up in London and go, wow, DXY 107, 110? What's the prism you have of DXY where things change?
Well, by what do you mean? So for the Fed, for it to have an impact on where...
I mean, for us, for people trading the market...
You've got 10 seconds to give us a number before we hit this break.
110.
110. There you go. That's what would scare him. 110. Jordan, thank you. Jordan Rochester of Nomura.
I'm Swissy stocky.
Coming up on the commodity market, Christian Malik, Global Head of Energy Strategy at JP Morgan, right here in London. That conversation up next.
We don't think demand is going to be growing, you know, more than 1.2 million maybe barrels a day next year, and non-OPEC alone can fill that without even thinking about the Fragile Five or what China is doing. So I think, the way we look at the trends, it's going to be a weaker market.
How are you?
Ed Morse of Citi, looking for a weaker crude market. Crude right now positive by 1% on WTI, $90.61. Brent, 94, up by 0.9. Brent crude this week through 95 briefly. We'll have the conversation about triple-digit crude, the prospect of that before year end in just a moment. I want to touch on the bond market. We had a look at 450 on a 10-year just in the last few hours. Today, in today's session, we backed away since then. We're down a basis point, 448. The 2-year came really close to 520 in the last couple of days. Wow. These are cycle highs for bond yields in America. In the FX market, off the back of that, yields up, dollar stronger. The euro 106.36, negative 0.2%. And in the equity market, worst day in 6 months and trying to bounce. Not much for bounce here, Tom. Let's be clear about that. Up by 0.25%. You joke about going to cash. Go to cash now. That's a pretty healthy return, isn't it? In cash in a moment.
Somebody asked me about that at dinner last night. They came up to dinner, and I said, well, you got to realize, this goes to the real yield story. If you're running the triple leveraged all cash fund, your cost of leverage goes up. Your real yield gets in the way. So you're not making net clean on triple leverage cash what you were making 8 months ago.
How many dinners did you have yesterday? We had dinner together.
Yeah, well, did I went to like 3 or 4.
A second dinner.
My people had to see me, and I wandered through the night.
We had dessert together.
That's why.
That was earlier.
I'm a little slow this morning.
I don't know what that was.
But
did you go out last night?
Yeah,
Okay, good.
I just, it's onward and
one of us is making the most of it. That's good.
On a Friday, we're going to get through this, and we're going to get through this by the little picture into the world. In my house, there's almost nothing on our guests. On my coffee table in my living room, there is a 100-page plus research report from J.P. Morgan 18 months ago, which brilliantly lays out the demand dynamics of what we don't talk enough about, which is emerging markets. Joining us now, Christian Malik, Global Head of Energy Strategy at J.P. Morgan. COVID got in the way. Let's just be honest. China's shutdown got in the way.
Small bump,
Do you reaffirm what you said 18 months ago about the durability of demand in EM?
For sure. Actually, I think it's always good to be here again. And on demand, what I'd say is that I think we're actually stronger in demand growth on a medium term than we thought we were. And the main reason is that when you look at all the fuels in the world, particularly the clean energy fuels, in the second edition of that report, we showed that the system, the distribution of that energy will basically fail the generation of clean energy. So you've got all these joules being generated, you can't get it to the consumer. What happens is we end up with a massive gap of energy in terms of what to fill. How do we fill that? We have to fill it through the traditional fuels. What that will do is drive more demand for hydrocarbons and therefore more demand for oil.
Right. I mean, we can spend an hour with you on, as joules, folks, as a physics estimate of energy, on the thermodynamics of EV vehicles and all that, but I'm not going there this morning. What I will say is you got to get traditional hydrocarbons from Saudi Arabia and such through the Straits of Malacca and up the Pacific Rim. Is that model still in place?
Absolutely. And in fact, when you think about Saudi's share of demand growth, and we've written about this extensively a few years ago, that ultimately with the industry retreating in terms of investments in oil, what we'll see is Saudi's share of demand growth going up to between 50 to 60% of all demand growth by 2030. Now, just to give you perspective on that, the average was 11% the last 30 years. The low was 4% when we had shale at its max. But a high cost of equity, more cash return to shareholders, a high cost of debt, higher for longer rates, and clearly a push to drive away from the transition has meant that the industry is massively underinvested. And look, we weren't a fan of this underinvestment thesis for a very long time. We turned bullish with the super cycle in 2020. I always like to say that. But that investment now is way too late.
Do presidential politics matter, given that crude production in America is close to a record at the moment?
I think it does in the sense that you could potentially push for more investments in shale, but the issue with shale, and it sort of goes back years, 5 or 6 years ago, we were all wondering, how is it when oil prices go up, you see so many barrels just turning up, blowing up lots and lots of wells. That was fine then, but you sort of reap what you sow. Now you're seeing productivity slow. So as a result of the way that was fracked, well data is showing us that productivity is now slowing. So even if we said, right, go drill, baby, drill, right, and in lots of investment, even if banks were to turn around and say, listen, we'll finance you, the issue is the wells themselves. It's not magic dust you just throw over wells. That slowdown is happening, and the marginal cost is going up. The one thing I probably learned this year in oil markets is that we tested 70 and we bounced back.
looking at prices now, 94 on Brent, looking at the bond market, yields push in 5%, 520 on a 2-year and 450 on a 10-year. Conversation we're having in the bond market is what is the new normal? Is it the old normal?
Right.
What's the conversation like in the commodity market? What's the new normal for commodity prices, given everything you've just told us?
Well, I love the way you talk about it, because I think the before and after, in terms of we were very bullish, and then we sort of took time out this year. We're very bearish in December, and we've basically gone back to bullish. So we're not just we've been quite tactical. The before and after is rates. The flow of capital into new oil supply is just not what it was like in the last 30 years. You had cheap money, a lot of productivity. So to answer your question, what that's doing is driving the long-term price, the back end of the curve, up to 80 and north of 80. We think it probably normalized towards $100. And just to sort of give you a bottom-up sense, the companies themselves, if you take capex, dividends, buybacks, debt, and windfall tax in this country, in Europe, you need at least $80 to be able to invest in marginal new oil. That's a fact. We did the analysis, we call it the cash break even. So that's very supportive for the $80. The question we've had a lot today is why 100? Well, when you look at spare capacity of OPEC, over the next few years, the only ones that are going to be able to fill that gap in supply is OPEC. And historically, when spare capacity has fallen to sort of between 5 and 10% of total capacity in the world, that's a risk premium, which I haven't used that term for a very long time in oil, maybe last year briefly, that will drive $20 above the 80 to 100.
So when you talk about OPEC being the big swing factor, we've been hearing a lot that Saudi Arabia and what they decide to produce is really going to determine whether things stay at 100, whether things stay at 90, or whether things stay below. Do you reject that? Do you think that that's sort of a simplistic way of looking at it, and in the near term, they have less control than people give them credit?
Well, it's a question. It's very, very, very. Do they have control? Do they not have control? I think ultimately the Saudis have played their cards very well and done a fantastic job managing the volatility in oil. Right. With that in mind, if they're taking a greater share of demand growth, they have a sort of fiduciary duty to make sure they're stabilizing the price. So people talk about an absolute price. I dispute that. I think what they're trying to do is make sure it stays within a range, which by definition means if we see a very cold winter or hurricanes and prices spike very quickly, they'll be managing the upside just as way they're managing the downside. So I've told generalists this morning, put your seatbelts on. It's going to be a very volatile super cycle. It's not going to be a straight line. And therefore, in some ways, I think the bullish factor to that in equities is Saudi can control that range. So generalists don't say, wait, this is way too high octane for me.
So right now, that's the reason why you think it's 100 and not 110, right? You think that that's where they're going to kind of cap it. But what about, say, Russia and the fact that they just banned exports of gasoline and things of that nature? Are there other areas that could kind of go against what we're seeing from Saudi?
I think other areas will be demand, and I think we're in demand discovery. I mean, everyone's got a view, what price does demand? We've looked at historic analysis, and $100 oil is not that expensive. In fact, it's sort of close to sort of $70 real. Again, before and after, it's higher rates. You've got higher rates, and therefore, what's the real sort of level of normalized price the market, demand, the world can acclimatize to? We don't know. We think 110 to 120 is fine. And therefore, at that price, if we start to see massive demand destruction, we're wrong. That's the point where I suspect Saudi and Russia will have to sort of manage that downside once again.
So the message this morning is buckle up. Buckle up.
Buckle up. We're very long, we're very bullish, but be very tactical when you get positioned in.
That's quite something, TK.
It is. There's a lot. This is really important. That the people we talk to, they all have different views. We heard that from Mr. Morris of Citigroup, different from Mr. Malik of J.P. Morgan. And you got to respect the density of the granularity, rather, John, that these people study something where we just go, well, Brent's 92, and that just doesn't get it done. It's way more granular.
I'm about to do that right now. Brent's 94. WTI's at 90. Christian, thank you. Christian Malik of JP Morgan on the latest in the commodity market, the prospect and the dynamics underpinning a triple-digit crude call worldwide. Bramo, some big calls in the mix there that could really shake things up, not just for what happens here in America, not just the electoral politics for the next 12 months, but also domestically in the UK and in Europe, as big oil importers, where it leaves them?
We never have a crystal ball. It's never easy. The number of different factors, though, is shocking. We have no idea even where demand destruction really kicks in. We don't. Everyone has a different place. We don't know how much Iraq and Iran can really produce. These are all sort of question marks hovering around a lot of different assumptions.
Dan Morris is going to weigh in on some of this. He joins us from BNP Paribas Asset Management. Catching up with Dan in just a moment. Your equity market positive by 0.2% on the S&P. Yields a little bit lower, just by a single basis point, but we are about to end the week very close to 450 on a 10-year.
We still think rates are somewhat too high over the long run.
As long as the politics lets the US be exceptional, you can have higher yields and a stronger dollar.
Turning to the US, we are a lot weaker than consensus with US growth.
Inflation expectations are fairly well behaved for consumers.
What we're seeing is the lagged impact of fairly aggressive monetary tightening really starting to bite.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
This is Bloomberg Surveillance live from the City of London for our audience worldwide. Good morning, good morning. Alongside Tom Keene and Lisa Abramowicz, I'm Jonathan Ferro. Your equity market positive here by 0.2%. It's been a rough, dicey couple of days in this market. Let's put it all together. Biggest one-day loss on the S&P 500 in about 6 months. Yields we haven't seen for more than a decade. Cycle highs on a 10-year, on a 2-year. This morning in today's session in Asian trading, we went through 450 briefly on a 10-year. We come back about a basis point, 448. TK, putting it all together, what a ride it's been over the last few trading days.
I'm going to go away from the equity market. I really take issue with the worry and the doom and gloom on equities. It's barely a pullback here with the VIX at 17.12, I believe, is a level. You think we had a 20, a 22, a 25 VIX. We got nothing. It's been resilient equity markets with the bounce back today. In the other areas, you're right, John, in foreign exchange, I can tell you it's an interesting study. It's not 1 or 2 pairs. It's like 10 or 12 pairs you can study. Sarah Vellis with us from Deutsche Bank coming up.
That's going to be very cool. Let's pick up on the euro weakness of the last couple of months, 10 weeks of it now against the US dollar. The resilience in the US data, the lack thereof in the European data. We've had some PMIs this morning in Europe, both in the UK and on the continent. And those PMIs, Lisa, are absolutely dreadful. I've used that word continuously over the last couple of months to describe European data. They are not good at all. And if you compare and contrast what we're witnessing in America, we'll go back to it next week. Just resilience, resilience, resilience. You look at Europe, breaks, 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 cracks, cracks, cracks.
It's getting worse. France really was shocking, coming in with the worst private sector activity going back 3 years or nearly 3 years. There's a question. At what point is the U.S. not experiencing the pain that it's going to experience versus is a completely different story than Europe? And really what has changed this week more than anything is which economy is most immune to higher for longer? Which economy is going to be weakest with higher for longer?
It's the United States, it has to be that with a dynamic sense. I do want to note that there is a surveillance adjustment here to French GDP off the Macron-King Charles soiree that we've seen in the last 24.
The pictures that have come from that.
Yeah, I mean, folks, if you want to recapitulate a Spielberg movie at Versailles, they succeeded.
Hugh Grant was there.
Yeah.
Arsene Wenger was there. Mick Jagger was there. I was not invited. Maybe the king didn't know I was in town. TK.
I don't
could
know.
have got the train over. And,
but there it is with French pop. We're all going to run down to Paris here on our way back Monday to take the Eurostar, and it's a Brexit. Yeah. It's a Brexit Eurostar. I
always think those banquets are so tone deaf in times like these. But that's my view. Whatever that's
let them eat cake.
Literally,
don't ask for high wages and let them eat cake.
Like Lisa's morning brief. There's pomp. There's circumstance.
Nice.
Very good.
You've been here too long. Equities on the S&P positive here by 0.2%. Yields a little bit lower by a single basis point. Lisa, 448.23.
Today, Fed Speak does return. Fed Governor Lisa Cook at 8:50 a.m. I know that you're very excited, Tom. San Francisco Fed President Mary Daly. In Minneapolis, Fed President Neil Kashkari. Both of them are speaking at 1 p.m. At 9:45 a.m., following what we saw over in Europe, we do get the U.S. manufacturing and services PMIs. How big is that differential, right? How big does it have to be? How big of a surprise does it have to be to cause further dollar strength? And at 10 a.m., this to me is really important. You know, we're going to hear from the UAW. They're having a Facebook Live event in Detroit.
So is that for the public or for the UAW people? I think that's an important distinction.
Or the automakers.
or both, right?
Okay.
The idea here
I meant serious.
is that they are taking control of the message in a surprise kind of tactic. And I think that it's a good question because it raises a point of, why is this time so different? Why has the tactic been so different for Sean Fain at a time when the auto manufacturers say, look, we're stepping to the table, we're going to bankrupt us? And he said, we have not gotten our fair share during the financial crisis. We have not gotten our financial share in the decade that followed. We have to get ahead of this before all of the technology changes.
One quick observation, the Fed speakers, what's the difference when they speak now versus Jackson Hole 2 cups of coffee ago? And the answer is real rates have moved. The story of the last 72 hours is 2.10% up to 2.11% on real rates. That affects every single person listening and watching.
Are we sufficiently restrictive now? Dan Morris, BNP Paribas Asset Management, joins us around the table. Dan, good to see you.
Likewise.
Are we sufficiently restrictive now?
Well, I think it's more a question of the time than the level. I think from here, no one's really expecting big moves from the Fed. Maybe we get another 25 basis points. Does that really matter at this point? Probably not. It's how long do we stay at this high level? And the message they wanted to give from the dot plot is that we're going to stay here for longer than the market thinks. We'll go back and forth about that particular debate. But it's when the pivot happens, how quickly the pivot happens, that's what's going to determine whether this ends in a recession or just a slowdown.
To BNP Paribas and back to France excellence in the 20s and the 30s, I'm sorry, it's always been a real rate study. You people are steeped in this. How does our world change with higher real rates and inflation-adjusted rates back to December of 2008?
I think we look with a bit more history. We get, certainly surprised by these level of rates because we haven't seen them for such a long time. But pre-global financial crisis, of course, this was quite normal. And I think the stock market did just fine and the U.S. economy did just fine with rates at this level. So it's not so much the level of the rates that's the problem. It's the adjustment. We thought we had gone through that adjustment last year, and that was rather painful. We're getting a mini replay of that now. But once we do get to what we hope to be relatively stable and a point for rates that they can start to move down, then I think the economy will be able to withstand it.
When you point to that era where the economy did just fine, it was also at a time where this was actually the rate being borrowed at. Right now, it is not for the vast majority of consumers and for the vast majority of corporations. In the U.S., they are not paying those rates. So have we really felt the effects of the monetary policy tightening that everyone talks about with shock? Or is it a long way away?
Well, I definitely have not felt the impact. And that's the whole, fundamentally the challenge for the Fed is to assess when is it going to come, how long is it going to take. But if you look at, I think, corporations by and large, they were smart enough to take advantage of rates when they were very low. They've, absolutely termed out a lot of their debt. You kind of consequently don't have the sensitivity to the moves in rates that maybe you had historically, which goes back to your point about resilience. So it'll happen, but I think it'll happen slowly enough that we don't see that in and of itself as a major risk.
Do you think that the levels that we're seeing now, specifically in long-term yields, are the new levels that we're going to see for the foreseeable future?
Well, probably not at quite this high, but something with a 4 handle, I think, makes complete sense. Just a rough rule of thumb, if U.S. trend GDP growth is 1.75 or so real and inflation's 2 or more, it's a 4%. And I think, especially what happened post the Fitch downgrade, I think it's levels now that seem much more sensical, if you will, than necessarily what we had when we were sub 4.
Do you sense this FOMC is confused?
I don't know if I'd use the word confused. Why do you say that?
Did you get a satisfactory explanation of what they're forecasting?
Well, if you always want to find a perfectly coherent and believable story between the dot plot and between what you get with the summary of economic projections, you could have a lot of fun. I don't know how successful you would be.
They seem somewhat mystified by how resilient this economy has been. Steve Englander of Standard Chartered's written about that in the last couple of days. They seem somewhat mystified about it. I think if you'd asked any of us 12 months ago what 5% interest rates would do to the US economy, we wouldn't have unemployment with a 3 handle and jobless claims down at 201,000, would we?
Well, I think that mysticism's pretty widely shared, if we're all honest, and it's justifiable insofar as we have never ever had this scenario that we've had over the last 3 years between the pandemic and the stimulus.
So why is it the consensus view, Dan, that we are sufficiently restrictive when we're also mystified by how the economy is responding to interest rates?
I think it's more the response to what we now, if rates are at a sufficiently or at a restrictive level now, it's still the basic principles of economics are still going to hold in terms that that's going to slow down growth. It's just how quickly, that's where I think we've been much more challenged in assessing, understandably. Right. I don't think it's a criticism of the Fed.
So BNP Paribas has been so good about nominal GDP guesstimates, about taking a real GDP and overlaying some form of inflation number on it. Do you frame the United States is a sub 4% nominal GDP?
Well, yeah, conceivably. I mean, we have to go back to, has the long-run trend growth rate of the U.S. changed in some kind of fundamental way, post-global financial crisis, post the pandemic? And, we still go back to, and we don't want to forget the longer-term trend issues that the U.S. faces, demographics and so on. But if there's an argument for that growth rate to be higher now, frankly, it does come back to AI. I mean, if the kind of fundamental key challenge that the U.S. faces, Europe faces, Japan faces, it's lack of labor, and if this is a way to increase productivity and at least lessen that constraint, that actually is the one thing that maybe gets you above a 4% nominal.
I look at this as just the arch issue. Greg Bowdle is more enthusiastic about equities, U.S. equities as well. Do you share his enthusiasm?
We're more cautious, actually, and it's as much an assessment of how adept is the Fed going to be at knowing when to cut rates. I mean, if we go back to, as we've discussed for 9 months now, about inverted yield curve saying a recession is going to come. Well, if that's, I think, fundamentally because the central banks in general have made a mistake and held rates too high for too long, that certainly can happen again. So I think our concern is that they are going to keep rates too high for too long. They're going to slow down growth too much. That's going to hit corporate profits, and the consensus estimates that we see for earnings estimates aren't going to materialize.
So the median projection of the Federal Reserve, if we were to ascribe a narrative, forgive me because I'm going to, they're essentially telling us right now that we can get back to 2% and unemployment
with
goes
no slowdown,
no higher than a little above 4%.
Yeah, we're not quite that
You're
optimistic.
Not there.
No. Nice story.
Of BNP Paribas. It is a nice story, isn't it? It's a story that they're not really telling, though, Lisa. They're just sort of projecting it without.
It's not their baseline, but
it
is their baseline.
Well, can you make sense of that? It's an objective, not the baseline. So our projections aren't forecasts; they're aspirations.
It was not a coherent total message. I think that we can all agree on that. The key question to me is, where are they wrong? Is it how much inflation is going to come down, or is it how much unemployment is going to go up? Is it the weakness or is it the strength? Right. And a lot of people in the market seem to be saying it's the strength, which is the reason why yields on the long end are the ones that are rising so much more. There's a question of that, whether that's getting embedded in market expectations as they push against.
I think Arthur Burns in Another Time and Place had aspirational smoke signals coming out of his pipe. There's just way too much information now, and all of it is predicated on guessing and forecasting. They're data dependent, and by definition, as Daniel correctly states, they're going to be ex-post.
You want less information?
I would like them to be more choosy, more surgical about the too much information they have now. Instead of, do we have 3 Fed speakers today?
I think we do, yeah.
I think it's
why not a 4th?
Look, I've said over the last couple of days, it's right to convey the appropriate dose of uncertainty that surrounds any forecast, and the chairman did a great job of that. I do think we need a sophisticated conversation about the underlying dynamics by which they're confused. And at the moment, it seems they are confused by how well this labour market has stood up to the interest rate increases they have done, which makes me wonder why we have any degree of confidence whatsoever about being sufficiently restrictive.
Correct.
That's a conversation we have to have with yields where they are right now at 450 on a 10-year and a 2-year pushing 520. If you are just tuning in, welcome to the programme. Equity futures right now just about positive by 0.16%. Coming up in the next hour, Sarah Malik of Nuveen, tons to talk about. I think we should wrap up the calls of the week so far as well here in London. And Rita Sen with that call on triple-digit crude by Halloween. Maybe that's the story just around the corner. Max Kettner of HSBC, given everything that's taking place right now, still super constructive, still saying we need to focus on what can go right next year. But Lisa, when you see moves like this in the bond market, sometimes you just can't help but think, what could go wrong?
That's the reason why you're seeing people sell tech, which is the one thing that really did well. I mean, let's be honest, that's really what has been the gains in the U.S. equity market. It's almost entirely been the Magnificent Seven. You strip those out, you're up less than 2% on the year for the rest of the
I'm going to go to the trading envelope function on the Bloomberg. I'm going to look at standard deviation moves, and we're all addicted to normalcy and up, up, up. And the answer is you're allowed to correct 10%. We're nowhere near that in many, many series. We have not seen any pain. OMG, what was it yesterday, John? The VIX went 14 to 17, down 3%, whatever it was. That's another day at the races and another time and
We had
place.
a 1.6% move. We just haven't had a move like that for 6 months.
Dow Jones Industrial Average like rocks.
It's been fairly snoozy, even with a banking crisis, although Mohammed said don't call it a banking crisis.
He was right.
We moved on, didn't we? Let's see if it comes back. AMH in New York, up next from London. This is Bloomberg.
As I discussed with President Zelensky, the people of Ukraine are steeled for this struggle ahead, and the United States is going to continue to stand with you. Today, I approve the next tranche of U.S. security assistance to Ukraine, including more artillery, more ammunition, more anti-tank weapons, and next week, the first U.S. Abrams tanks will be delivered to Ukraine.
The President of the United States, Joe Biden, speaking in a meeting with Ukraine's Zelensky. Anne-Marie from New York on the UN General Assembly in just a couple of moments. Let's get you up to speed on the price action. Equities trying to bounce positive by 0.2% on the S&P yesterday. Biggest one-day loss going all the way back to March. Remember the banking issues? Moved on from that pretty quickly. If I told you back in early March, though, that cycle highs on bond yields were in our future, I'm not sure what you have said back to me. 520, got close to it in the last couple of days on a 2-year, 450. We had a little look at it in today's session on a 10-year, 448.64, Lisa. Yields almost unchanged on the day, but what a move it's been over the last couple of days.
Ben Carlson, out on X, pointed out that the pandemic lows for treasuries not just give you two denominations, 2-year 0.09%, 10-year 0.5%, now 5.14%, 4.447. He says it's kind of crazy nothing is broken yet. I think we all can agree. When does something break, or does it not break because this is the new normal?
Well, I did say, and Lisa, I know you're on the same page with this, something did break back in spring. The banking system started to break, didn't it?
Which then was quickly remedied. So this raises a question, would we have felt the effects if policymakers hadn't stepped in to ease the frictions, the fissures that happened during some of the banking crisis that wasn't?
I always go back to that Torsten Slok deck over at Apollo. And he's got the delinquencies, he's got bank lending, all of that stuff in there. I was going to say all that good stuff in there, but it's bad stuff right now. So you are seeing that tightening start to come through. You're certainly not seeing it in a profound way in the mortgage market or housing in America, and we can talk more about that. But these are reasons why the likes of Andrew Hoddenhorst, the city, thinks that maybe you see more price pressure, that the labour market does matter, that the housing market does matter, and that could contribute to a re-acceleration in inflation. That's why I think this Federal Reserve has so much uncertainty about the future, because there is that risk that those things materialise, and they don't want to entertain any kind of conversation about rate cuts anytime soon with that in mind.
At the same time, there isn't a lot of discussion about going much further and raising rates much further. There's sort of a tacit understanding that they've gone as far as they can go. And Jim Bullard was saying he doesn't believe in lag and lag effects, long and lag effects. If he doesn't believe in that, well, then you would have to assume that rates should be higher if we have unemployment rates so low and jobless rates coming in even lower than people expect.
I'm so glad you brought that up. That was an incredibly important statement by Dr. Bullard. The idea here of taking a model from the 50s and 60s, from a goods and services America that was totally different, John, and bringing that monetary timeline out to the modern age, and he would say we transmit rapidly faster.
Credit to Bill Dudley, former New York Fed president, for writing that column in the summer. I think about a month before Jackson Hole, he was raising that question whether we'd already seen all the policy come through already. We've lived with it, we're down with it.
We're going to do the shutdown now, but before that, we need to look at something really shocking. Our Margaret Collins in Washington reports in conversation with Mr. Zelensky that there may be a winter war in Ukraine. That's an assumption not made. Anne-Marie Horton is very familiar with this, particularly with continental European seasonality and war. Anne-Marie, I was shocked by Peggy Collins' story, the idea of autumn, okay, I'll take it. But we're going to have a winter war in Ukraine?
Well, I think what you see from Volodymyr Zelensky, who was in Washington, D.C. yesterday, was that he wants to make the point very clear to not just American lawmakers, but the American electorate, that they are not going to stop in this counter-offensive, and they want to continue to try to retake these cities, regardless of how difficult it may be with the harsh winter that you see, especially in eastern Ukraine. Peggy Collins, our bureau chief in Washington, D.C., was a part of a group of reporters that got to speak to him. I was more taken with, and I know they were pressing him about what was the conversation between you and Speaker McCarthy. And the quote was, in their private meeting Thursday, House Speaker Kevin McCarthy, quote, said that they will be on our side, according to President Zelensky when he sat down with these reporters last night.
AMH, we said it earlier this week, this is a wartime leader in Ukraine, and I think we have to say that up front. Just purely from an observational standpoint, not a judgment, do you sense a degree of frustration with the leadership of Zelensky within certain nations in Europe and across Washington, D.C., beyond the obvious places?
I would say this goes beyond even Europe and Washington, D.C. I would say that anyone who has been giving this individual help in the meetings he has had, there is a little bit of frustration for potentially how much the Ukrainians ask, and also the fact that these leaders are dealing with an electorate that is growing uneasy. There is a sense of war fatigue that they are all dealing with. Many are also dealing with upcoming elections. So this is a difficult one for Zelensky and a difficult line for him to walk, especially as we do know what President Vladimir Putin wants to do. Putin wants to keep this going at least until the U.S. election of November of next year. So Zelensky knows that he needs to keep the pressure up when it comes to the aid that he's asking for. But when you're not making a tremendous amount of progress in terms of the counteroffensive, the messaging becomes very difficult.
And Maria, how much is aid to Ukraine part of the whole debate that's factoring into the potential shutdown in Washington, D.C.?
It's factoring in a lot, because I would say that yesterday, one of the key things to watch out for, and we talked about it yesterday morning, was that vote at 10:30 a.m. And this was just a vote, a rule, to then allow the defense bill on the floor to debate it. And our Kayleigh Lyons spoke to Marjorie Taylor Greene, who voted no against that. And she had said that this was because of Ukraine aid. I'm trying to find the quote now. She said it was because of Ukraine aid. And she says, if you take the Ukraine aid out, I would be okay with even debating that defense bill. And I say this is important. It's not in the continuing resolution, but that vote was going to show how united McCarthy's party and his caucus is when it comes to keeping them together. But they couldn't even get a bill on the floor to debate. So you could see how far apart the centrists are in his conference and some of these hard right members in his conference. And Ukraine aid is one of those really big sticking points.
Emery, do you expect there to be some sort of vote of confidence with Kevin McCarthy? Is he at risk of losing his House Speaker role?
Potentially. You know, you have the likes of Matt Gaetz, the representative from Florida, who says he wants to begin every day with the prayer, the Pledge of Allegiance, and a motion to vacate, wants to get rid of Speaker McCarthy. This will become a little bit more clear whether or not we will see it, depending on how the continuing resolution plays out. Likely there'll be a government shutdown. Likely you'll have to pass a clean CR, and then that would be a moment that potentially you see some individuals on the hard right say, you have not delivered for us, so we do not want you as our speaker.
Okay, that's an important distinction, Amory. We feel sort of out of the loop here in London. Let's cut to the chase. You're stating that you frame a shutdown as a likely occurrence now?
Yes, Speaker McCarthy has sent lawmakers home. They are not even in D.C. to vote. And they can be called back, but some of them have left. So they are home now until next week. The government runs out of funding September 30th.
Amazing. MH, thank you. Anne-Marie over in New York for the UN General Assembly. I've got no idea.
He loves talking about this.
For those just tuning in.
That's sarcasm.
I really don't, for whatever that's worth. All right? I really don't.
I'm right there with you.
It drives me nuts. I think it drives everyone crazy. And maybe this is the real deal. Maybe we do shut down, put that together with a strike at UAW. Maybe you do slam the brakes on a little bit of a solid, resilient U.S. economy.
I want to make clear, particularly to our international audience, you know, I grew up in a house where there was hysterics about the debt and the deficit. That goes back to Hal Bronner and Bernstein's classic book. And John, a shutdown is not the same as an argument about the debt or the deficit and OMG, trillions of dollars, we're all going to die. A shutdown affects people who don't have the luxury of going to a font of savings to get through whatever. Millions of people, and some in, medical and
certain people in certain roles that will be going to work and not getting paid, Tom.
I just want to partition this from the fiscal follies over to a shutdown, which is absurd.
I hear you.
It's absurd.
Let me get you the next 35 minutes or so set up. This is what the schedule looks like. George Saravelos of Deutsche Bank on foreign exchange is going to be joining us shortly. Dollar stronger again this week against the euro. 10 weeks of it. Lots to talk about there. interest rate policy, the difference between growth in Europe, not much of it, growth in America, pretty solid. And then we'll catch up with Roger Boodle, the Capital Economics founder, good friend of this program, Tom, over the years. I know you're looking forward to that one. That's in the back half of this hour.
Boodle on the follies of London. There's a little bit going on. You think he drives an EV?
There's a lot going on. We can talk about that with him, actually. Equities on the S&P 500 trying to bounce from London. This is Bloomberg. Potentially the worst week since March, heading towards a third week of losses on the S&P 500.
Closer to Bramall
Equity
than me.
Futures up, a lift here by 0.2% on the S&P. What are you two talking about? On the Nasdaq, up by 0.4% on the Nasdaq 100. Futures doing a little bit better. Do you want to settle the argument now or on the next board?
No, it's good.
Honestly, can I just say this?
Sure.
Just because the market is down doesn't mean that someone who's saying that it is down is gloomy. They're just reporting the facts. And so good job reporting the facts and putting it into perspective.
Fortunately, we all fly on different airplanes.
We're bouncing now. Okay, anyway, you two carry on arguing. Let's turn to the bond market. 2-year, pushing 520 a little bit earlier this week. A 10-year in Asian trading, pushing 450, went through it briefly, coming back by a basis point. These are yields we haven't seen since 2007 on a 10-year. It's amazing to see a 30-year yield now looking at, what, 460 maybe? 456.39. Big moves this week. Cycle highs on bond yields. Resilience in the US economy. No resilience at all in Europe. Let's turn to the euro. The euro negative against the US dollar for 10 consecutive weeks. The euro right now 106.39, down by 0.2% on that currency pair. Tom, the data out of Europe, I've used that word dreadful too many times. Ugly, brutal, just not nice. Sub 50, contraction, France. Not much better.
Different shades here, and maybe there's all different stories to it, but the answer is they don't have the dynamism of the United States. It's going to be, where are they in November? Where are they as they drift into winter? And particularly if oil prices stay sustained. We haven't even touched on gas, natural gas.
Well, this is what we were talking about with Jordan Rochester, right?
Yeah.
Namora, you get the pickup in gas prices. That's the toxic brew, Bramo. Toxic.
There are a couple of them.
Under surveillance this morning. 3 holds across the board for major central banks this week. The BOJ joining the BOE and the Federal Reserve, leaving rates unchanged. Governor Ueda tamping down speculation of a future rate hike, saying this, because we aren't in a state where inflation accompanied by wage growth, sustainable and stable inflation, is in sight. We're patiently continuing with monetary easing under the current framework. The BOJ. I thought he made some comments recently that if wage growth remains buoyant into year end, they'll have a little look at moving away from negative rates. What happened to that?
I don't know. JP Morgan thought that maybe by the end of the year they could abandon negative rates, and by next year they could abandon yield curve control. Pushes back against that even after getting a hotter than expected CPI print in Japan.
North of 3.
Yeah. How much are they getting cover from the fact that he doesn't have to say anything and people are just quavering under the fear of some sort of foreign exchange interventions? They're not going to even bother.
Like us, they have different inflation metrics, including fresh fruit, and there's 40 other ways to slice it, including a Tokyo CPI as well. But the answer is, when we say 3 or 4% inflation there, it's not the same as 3 or 4% inflation in America or the continent of Europe. That is a whole new world, after all, for the people of Japan. That is high inflation.
Yeah, when you've been living with 0.
Yeah.
No inflation, you get 3.
I think that's behaviorally and politically, that's
Should we say that's like 6?
I haven't done the work. I don't know, but yeah, you can make that study. You can do it on the Bloomberg if you do a double chart overlay with 2 y-axes.
Nice. You should do that, TK.
My free time.
Let's get you your update on the big 3 automakers bracing for more walkouts potentially today as they remain far apart from the UAW on key issues, including job security and pay parity for temporary workers. Union President Sean Fain expected to make an announcement, as Tom just mentioned, through Facebook Live at 10 a.m. Eastern Time. We've got a deadline, Tom. It's midday. And ultimately, the deadline apparently with UAW is never midday. It's 2 hours before.
Exactly.
So there was a midnight deadline and there was a 10 p.m. news conference. So basically, if you don't have your stuff together, almost said something else then. By midday, he'll do a news conference at 10. Restraint. They'll do a news conference at 10.
Keep it together, John. That's okay.
Maybe make this strike a little bit deeper.
Where are the automakers? Am I surprised that I haven't heard massaged statements from various automakers?
Well, you have. They've talked about how it's unaffordable, and the 36% wage increase that you are asking for, that they are asking for, is not affordable. What I find interesting is it's not about the salary. It's not about the take-home money. And this, according to one union member, it's about job security and product. We need to keep jobs in this country. They're taking billions in tax incentives, EVs, but when it comes to keeping jobs here, they won't guarantee anything. And that is ultimately at the crux of the debate.
Job guarantees, the stakes are higher, big EV transition. It's not going to be straightforward. We're learning that in the UK. It's going to be difficult in the United States as well. I want to finish on this story. Apple's newest iPhones and watches went on sale in about 40 countries today, including Australia, China, the US and the UK. Sold out pre-orders and long lines. Long lines, we're still doing long lines. Outside retail stores indicate strong initial demand. Bramo is going to get a new iPhone 15.
Only because I cracked my existing phone. That's the only reason why. Yeah, but I'm not going to be waiting in line. I don't understand lines.
Why are they still doing that?
Because it generates excitement, demand. You're going to be in on it.
Apple, but like, why do you want to do it as a consumer? You can go and just, you know, get it from.
You go hang out. You're the first adopter.
That's
you
still
can
a
go to
thing.
your friends and you can be like, look at all these cool gadgets.
Is that still cool?
I don't know. Am I cool? I don't think so.
Pretty sad,
I don't think that I could do that.
Line up when you don't need to.
But except if you're with your friends and you're talking and there's the excitement around it and it gives you something to do. I don't know. I'm making a pitch.
Do you want to go to Covent Garden today?
Actually, I've been in that store now that you mention it, and the answer is no. I'm just taking it in because I think what Dan Ives would say is a bull on Apple is it's not an $1,100 or $1,300 or with 1 terabyte $1,600 transaction, because you're slipping into it for $46.32 a month off some stupid plan at a company. I really take issue with the snobism and bad research of a lump sum purchase. It ain't happening.
I didn't do it either. I don't think you did either. You do the.
I'm not buying the new one. I still owe money on this one. I called him up and I said, I didn't even know where I bought it. I'd forgotten where I bought it.
This is paid. We're done and dusted. Those payments
well,
are
then
done,
you can slip into, like Bramwell, you can slip into a new one.
Upgrading until they ruin it.
George is about ready to walk out of the room. Should we get to our guest?
I think you probably should, yeah.
Let's get to our guest. Joining us, and this is really, really important, folks. This is what surveillance is about. Joining us is George Seravolis, Global Head of Foreign Exchange Research. And as we had Jordan Rochester with us a bit back, you take a starkly different view. I want to set this up with selected firms saying Swiss franc dominant, lots of financial tension, Swiss franc will do better, others will do weaker. You go the other way. Why will Swiss franc weaken and other currencies will prosper in this time?
So thank you for having me. We did just publish our outlook for the end of the year, and we've been very bullish on the Swiss franc for more than a year, actually, but this is the first time where we switched. And there's a couple of reasons. The first one is, and the most important, is the central bank. They came out yesterday and they've said inflation is now below target. They don't need to hike rates now, and they think they're done. And the fundamental reason behind why the Swiss franc has been so strong is because of the central bank that's been supporting it. So it's starting to look more attractive as a funder, it's looking expensive, and that's why we changed the view.
In the last 72 hours, and go with the real yield in America, but many other indicators, John's been great about framing out what gilts have done, what Germany's done, Bunds, what we've seen in the United States of higher yields. Is that, as a general statement, the ultimate fake-out rally in yields setting us up for a general global disinflationary trend?
Well, I think this has been the big question throughout the year. Are you going to get a hard landing? When especially does the US slow? Everyone's been focused on this US recession. So the key question we need to ask ourselves is, why isn't it happening? And there's theories around exceptionalism, AI, but if you look at the data, the simple reason is the Fed rate hikes are not being passed through. So, for example, corporate interest payments are actually going down. And that's because everyone's on very fixed term borrowing. In the housing sector, you're in fixed mortgages. So the slowdown will eventually mathematically come, but it's just taking a very, very long time.
Are you seeing a cleaner, quicker transmission of monetary policy in Europe?
Absolutely, and I think that's the key difference if you look globally. So let me give you an example. If you look at average mortgage rates in the US, they're up by 20 basis points since the rate cycle started. If you look at Sweden, they're up 200 basis points. We're talking about a magnitude 10 times as different. So what's going on in markets is quite different to what's going on in the real economy. And I think this key question of transmission is what's affected this currency divergence, so to speak, and will matter a lot going forward as well.
I'll tell you what I see, and then there's a question involved in it. My observation is it's quicker and cleaner. It's hitting growth. It's not bringing down inflation. So can you help me understand why it's not bringing down inflation? Because it's meant to go as follows. Comes out of the central bank, hits growth, inflation falls. That's not happened in Europe. Why not?
So it's interesting you mentioned inflation. What I would say in the US is while growth is surprised to the top side, inflation is actually being surprising to the downside. So everyone's growth numbers have been constantly revised higher, but they're moving down inflation. So in the US, inflation is actually doing even better in terms of deceleration, and that's because the supply side's improving. In Europe, there's a bit of a lag, but if you look at the month-on-month numbers, so in the US, everyone reports inflation numbers in month-on-month terms.
Sure.
In Europe, we never get to see that. Month-on-month inflation in Europe's also slowed down. It's 0.2, 0.3 the last few months, if you adjust for all the distortion. So it is coming down. I'd say that's one reason why we've got the ECB topping out, and the ECB sees that as well, and that's why they're topping out at 4%.
So why are you bullish on the euro?
Well, in the piece we just published, we're neutral, and I think the reason is this US exceptional story because of delayed pass-through. And if you look at Europe, rate increases are being passed through very quickly because it's a bank-based system. So most corporates have their loans against banks, so immediately cost of borrowing is going up. That's what's impacting growth. And I think the key question is, when does that catch up with the US? We don't have high confidence. You're about immediately to go into a very soft landing into the US, or a hard landing, so to speak, and therefore we're pretty neutral euro.
Why wouldn't you be negative on euro? Why wouldn't you see more dollar strength ahead?
Point number one, if you look at relative data surprises, they're quite extreme. So the market's really pricing this US exceptionalism versus Europe. If you look at the PMI numbers today, they're actually surprised to the top side, excluding France, where there seems to be a bit of a statistical issue. But potentially the market's getting a bit too pessimistic on Europe. And number two, if you look at rate pricing, again, it looks pretty extreme in terms of that Fed ECB divergence.
Speaking to that sentiment issue, being neutral sounds bullish, to be honest with you.
Exactly, that's exactly what it is.
So far this week, George.
I would give you one example. People talk about car exports and how China's taking market share. And everyone has this chart of Chinese car exports going through the roof.
Yeah.
But no one shows European car exports. They're up 20% since COVID. If you look at the Euro trade-weighted index, it's actually at record highs. So the point here is it's not the euro that's weak, it's just the dollar that's very strong. And the euro is actually pretty strong against the yuan, against sterling, against Scandis.
Within 24 hours of the Putin invasion of Ukraine, David Folkets-Landau sat with us, and he said there will be a fiscal response, a fiscal stimulus within Europe. Is this austerity still in Europe? Is the austerity mindset still within Europe, or are we going to see a fiscal renaissance within Europe?
Well, it's definitely changing. And if you look at this year, you're actually seeing the peripheral economies, so to speak, Italy, Spain, they're doing better precisely because of the fiscal stimulus that's flowing through the NGEU. But fiscal is definitely one story that's supporting growth everywhere. So to answer the point on inflation, inflation's coming down because of the supply side, but growth's holding in even in the US because you're still seeing delayed fiscal. So we've got the fiscal rules up for debate, but given the growth slowdown, I doubt we're going into austerity anytime soon.
George, this was awesome. It's always a clinic. Should we move back to London? Should we make that happen?
Absolutely.
You know?
We.
We.
Is this the royal we?
We.
All of us?
Yeah, of course.
Yeah, we're all going to go to London. No, I think that the timing works a lot better.
Doesn't it? Don't you feel rested?
Like,
so much more relaxed. You know, wake up, have breakfast, go to the gym, tea cake.
It's shocking for those of you in America that have not been over here. The polarity between New York and London is never, to me, has never been greater.
Yeah.
Never been greater.
We'll talk more about that, Tom. If you are just tuning in, welcome to the programme. Your equity market positive here by 0.2%. In the bond market, yields just about unchanged, but some major moves this week. Through 450 briefly earlier on this morning, 448.44 on a US 10-year. Love our audience writing in. People stand in Apple lines to make money in the resale market, taking them back, selling them into other countries where it's hard to get. Chris Hutchinson, thanks for writing in this morning.
A lot of people writing in on your interview with Daniel Levy. I think we're going to play a little bit of this here in the 8 o'clock hour. Why did that make global headlines in 60-plus entities?
Because he barely talks is the short answer.
He rarely. How did you get him to do that then?
We were working
Did you get tickets for Arsenal
We
Tots?
worked on this for a long, long time, and we finally made it.
Did he give you? Did he give you seats?
I've got no seats. I don't get anything in return. You think I get seats for Sunday?
I thought you only did it to get into the derby here this weekend.
No, the interview was the gift. The fact he never talks and never talks to us.
I didn't know what to expect. I've never even seen the guy, frankly, but it was fascinating.
I think he was pretty open about what the club's gone through.
I was thunderstruck.
He's clearly in a much more comfortable, happy place to talk about the football club because they're doing so well. so far, and they've spent a lot of time, a lot of money.
Ian Wright went mental. He went absolutely nuts. He saw
former Arsenal striker.
Yeah, he saw what you did, and he's like, "Who is this guy? Let's get Ferro. What is it? Match of the day? John Ferro, match of the day."
I got some feedback. They wanted the Glazers next. Yeah. They wanted that as the next interview. Todd Bowley as well. We're trying to figure that out.
The committee left the additional rate hike this year in the dot plot. I think that may be a good thing to do as insurance to make sure that core inflation especially continues to come down. I think the risks are building that inflation could hang up at a higher level or even go higher based on the idea of a reacceleration in the U.S. economy.
That right there is the risk, and jobless claims in the last day or so speak to that risk. That was Jim Bullard, the former St. Louis Fed president, sitting down with the brilliant Michael McKee a little bit earlier this week. The moves we're seeing in this bond market off the back of that risk of higher for longer and maybe a re-accelerating inflation story in the United States, lifting yields higher on a 10-year at the moment, 4.48 on a 2-year. Let's call it 5.13. We're getting really close earlier in the week to 5.20. So yields up, stocks down, dollar stronger. Equities down yesterday, biggest one-day loss in 6 months. Futures this morning positive by about 0.2% in the FX market. Talked about this number a few times, worth talking about again. 10 consecutive weeks of euro weakness against the strong dollar. The euro against the dollar, Tom, 106.39. That currency pair negative 0.2%.
When we invented surveillance, it is all about what we just witnessed. To see the polarity of the Nomura Deutsche Bank call on the set of currency pairs we look at is the raging market debate that's out there into the end of the year.
Constructive Europe.
Yeah.
He used the word neutral, but neutral, let's be clear, the word neutral is constructive relative to the bearishness we have heard all week about the continent, particularly off the back of the data we saw earlier today.
This is an important conversation, whatever your politics. Roger Bootle joins us now, founder of Capital Economics, and what's important about that is the day they published, they were authoritative. He is a conservative voice in the United Kingdom with a shingle out at the Telegraph often. And we talked to him now, literally big time, going to rip up the script of what we have observed in the London battle of the Conservative Party, maybe an ascendant Labour Party. Tony Blair out, talking up Labour to a great extent. Bootle of Capital Economics, do you drive an EV?
Oh, certainly not.
You don't, you certainly not, you don't.
I don't drive. I don't need to.
For our American audience on radio and TV, it's basically London is under a debate that's encapsulated in what, Lisa, 2025 United States? Is that where we're sort of heading? Explain to our global audience how ESG and the timeline of the distribution of electric vehicles has been crushed by the Prime Minister, the Conservative Prime Minister.
Yeah, this is really interesting because a succession of Conservative governments following on an initiative begun by Labour laid down a pretty tight schedule for a whole series of green anti-climate change measures, including electric vehicles, heat pumps in houses.
Right.
This has been it's been an extraordinary episode because we all know that the ambition is fine. We want to get to net zero. That's fine. But getting from here to there has always been extremely difficult. And it wasn't clear that we could do that with existing technology. And it wasn't clear quite what the costs were. Quite frankly, I think British politicians have played fast and loose with the public.
Well, this is important. Ferro's been out front on this, way out front on this, talking about virtue signaling. The Telegraph mentions Rob Henderson up at Cambridge talking about the elites and how they look at luxury belief and lecturing and that. This translates across all of the Western world, and that we know what we're doing, trust us. Is that under threat right now politically?
Oh, absolutely. I think it's very interesting what the Prime Minister's done. I think he's been rather late in the day, by the way, because plenty of people in the Conservative Party have been urging this, but he's realised what the electoral penalty might be for carrying on, and equally what the electoral prize might be, because Labour, of course, have taken exactly the opposite tack. So we're now beginning to see the emergence of clear green water between the two parties.
I think this is really, really important. And what I want to say up front, Roger, this is not about denying climate change. No. It is not about that whatsoever.
And Sunak said that.
This is about being transparent with the public about the cost of the transition. And Roger, I think the point that you're making is that we're not being transparent enough
Absolutely.
about how costly this might be. Can you help us put some numbers on it? Help us understand how hard this is going to be?
I can't put the numbers on it, but let me tell you, and Sunak quoted these figures the other day, what ordinary people are being asked to pay is an extra £5,000, £10,000, £15,000. And the dollar amount's not much larger than that, obviously a bit larger. Now, for well-off people and for the elites, this is chicken feed. But for plenty of people, this makes all the difference between a livable life and, frankly, penury. So it's been, I think, not, frankly, a very edifying episode of the last few years. Politicians living off hope and promise and aspiration rather than getting to grips with the nitty-gritty. And as you say, this is not denying the climate change point. There's another aspect I think is very important here. A lot of people don't realise that Britain has been in the forefront of cutting emissions. We've cut them very, very substantially. And of course, the big emitters are elsewhere in the world who, should we say, are not doing that much.
Maybe there's uproar right now because of the financial situation that the United Kingdom has found itself in. And a lot of people in the sort of back rooms are saying it's because of Brexit and it's because of the importation of a lot of the inflation and of some of the lack of trade deals. You scoff. Why?
Well, I have to mark your card if you didn't know. I was a Brexiteer. But even if I were not a Brexiteer, I'd find it really rather tiresome, the number of times that people just trot out Brexit as the explanation for everything that's gone wrong in this country. There's plenty wrong in this country, and there's been plenty wrong for a very long time. Nothing whatever to do with Brexit. I think it's quite clear, really, although Brexit has probably had a disadvantageous effect on the British economy, which I don't find entirely surprising. I thought that would happen. The scale is minimal, frankly. Look at the trade figures. Look at how we stack up against other countries. Germany has done far worse than the UK. And as far as I know, Germany hasn't left the EU.
Well, but some people argue that the lack of labor is directly tied to some of the immigration barriers that have sprung up from that whole affair. You're shaking your head again, but there is this question of, well, what are some of those effects? How much does that factor into the uniqueness of the inflation and slow growth that the UK is in?
Well, I don't think very much so, because the fact is that last year we had record levels of immigration into the UK, absolutely massive. Now, the difference is now these people are, of course, coming from outside the EU. Now, there could be something to the idea that EU workers were particularly prominent, as indeed they were, in the hospitality sector, and there's not a direct substitution between the workers coming in from the rest of the world and the workers that used to come in from the EU. That's possible. But there's something else here, you know. During this period where some sectors, including hospitality, have been suffering from a shortage of workers, public sector employment has gone through the roof. You might just as well say that the problems have been created not by Brexit, but by the overexpansion of the public sector.
75 years, I'm looking in the right column of a given paper, and the doctors are on strike at the hospitals. The NHS, by every estimation, including our NHS expert, John Ferro, is completely broken, busted. What can Americans learn from the failure of British medicine?
Right, well, first of all, the NHS is by no means the only, as it were, non-American alternative available for the health service. I mean, I'm not a great admirer of the NHS, nor am I a great admirer of the American system, by the way. And I think one's got to think clearly and with imagination about what's on offer. Australia has a good system, Singapore has a good system. I think France has a pretty good system, actually, where you're asked to pay a sum to visit a doctor, always, and if you really are against your limits financially, you can reclaim that amount. But the idea is you're asked to pay. I think the British system of not having to pay for anything is straightforwardly bonkers.
Yeah, Uwe Reinhardt, Princeton, the late, great Uwe Reinhardt, Australia's the model.
I think the thing that people outside of the UK don't quite understand, particularly those in the United States, you can still have a private healthcare plan in the United Kingdom. That seems to be lost in this debate whenever I hear it come up. You can have access to the NHS and also have a private plan. If you work in an institution like Bloomberg in London, you will have private healthcare on top of your access to the NHS.
True.
And I think on a percent of GDP, the US is 16, 17, 18%, and UK is 10, 11, 12.
Yeah, some people might say the US figure is a little too high, to be honest with you, Tom, but we can have that debate at the time.
One good thing about the NHS, there are some good things, is it has helped to to keep down healthcare costs. I think the problem with the US system is you get massive inflation in healthcare.
Can you come back and actually talk about capital economics at some point? we didn't
start the conversation there next time.
It's Friday. Tuesday we would have done capital economics.
Roger, it's always a pleasure to see you, sir. Pleasure. Thanks for being with us. Roger Biddle there of Capital Economics. TK, the tension of things in the United Kingdom at the moment.
I'll be blunt, folks. The newspaper debate here, Bloomberg News, FT, 47 other newspapers, I don't know. It's so much richer, John. It's such a more complex.
What do you think the difference is?
Screaming. There's more units with Mr. Murdoch retiring. He's the one that invented it. There's just more units. I've been reading the Sun.
I would say this about the UK papers. I think they're far more transparent about what their politics are.
Yeah, I mean, I look at page 3 or page 6 of the Sun, and, I'm learning a lot about the British system.
Sarah Malik of Nuveen is coming up next. Your equity market's positive by 0.2%. From London, good morning.
I think we roughly know what the impact of monetary policy is so far.
I think the real core question kind of haunting markets at the moment is what is the neutral rate?
We're much more dovish on the Fed, and in general, we're much more dovish on growth.
A stronger dollar will be much less damaging to the United States in the short term than it is to other people.
Unfortunately, we need a recession to really correct some of those imbalances.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene in London, on radio, on television, on a Friday. And all we know is things have changed. After 3 central bank meetings, I've got to harken back to November 2008, John, because you're hot, then you're cold. You're yes, then you're no. You're in, then you're out. You're up, then you're down. The 10-year real yield is up. We are back to yields back when Katy Perry was telling us you're hot and you're cold.
Did you just want to sing that song?
I just did. I just honor Katy.
I think you've got to go back to 07 for where the yields are currently.
Katy this week sold, are you ready for this? She sold her publishing catalog this week to David Rubenstein.
Very cool.
To Carlyle.
Didn't know that.
That's what triggered in my head. And I said, what was Katy doing? In November of 2008, you've heard John Ferro talk about the yield structure that's out there. We're back to 08, 07, 06.
I'm sure David appreciates that rendition, Tom. But certainly, yeah, we've seen some massive moves in this bond market this week. It's been phenomenal to see the 2-year pushing 520, to see the 10-year going through 450, and still sitting here asking the question, are we sufficiently restrictive? Are we? The Federal Reserve thinks perhaps we are, based on the economic data we've had so far. There are others out there, Tom. I like to pick on Neil Dutta of Renmac often. Neil Dutta thinks maybe we're not. Maybe this economy could re-accelerate.
And pushed against a shock of the yields. Let's go to Krugman talking about plain vanilla and disinflation coming in. George Saravelis making the idea of the granularity of month-over-month or 3-month annualized statistics, as Furman of Harvard talks about. The answer is there are disinflationary trends in place. Lisa, it's not only the U.S., Saravelis suggests disinflationary trends in Europe.
How big are those disinflationary trends? Are they enough to really keep the ECB from hiking further, and whether they're going to drop rates lower? I think the big sea change this week is just the longer-term yields going higher. This is not being driven entirely by the front end. And yes, I'm going to have Katy Perry in my head for the rest of the day, and we can't really move past that time. You're not allowed to start at such a distracting
You've got to see how he plans this show.
I mean,
we're both sitting there with the Bloomberg terminal sitting in front of us, and Tom's scrolling through the lyrics when Jordan Rochester was on.
What are you looking at?
Trying to work out what song and which verse he's going to use.
And that was
Have you got any more?
Hey.
Was that?
Look, seriously,
was that singing? Does that count as singing?
We're going to interrupt the show here first.
We just did.
There's a great photo of a guy.
Now you're asking for permission to interrupt the show.
I'm interrupting the show right now to tell you that there was a great photo of Mike Bloomberg with Sir Paul. And one of the things to do in London right now with Bloomberg Philanthropy support is to go over to the newly opened National Portrait Gallery and see Paul McCartney's black and white images from 1963-64. And when you're over there, she loves you, yeah.
Oh,
yeah,
come on.
Like that.
We're going to turn to the price action.
Please. Let's do a data check.
TK's going to work on
Sarah
his next
Malik's
song.
going to walk off the set.
Sarah Malik, I hope, is still there. Equities on the S&P positive here by 0.3%. Yields come in a single basis point at 448. If you want to know where crude is, back in the 90s, up $1.04 today. $90.67, up by more than 1%. Right. And the dollar is stronger against the weaker euro, 106.43.
I want to hold her hands Sarah Malik with us now, Chief Investment Officer at Nuveen. Sarah, the fear is out, price down, yield up. Should we be in a sense of panic or frenzy or caution, or is this a normal adjustment that we will survive?
Well, there's two issues the market needs to adjust to, and that's what's going on with the economy and what's going on with rates. The economic soft landing narrative is definitely being challenged, and the markets had started to price that in. So that's what the markets are adjusting to. And rates, of course, interest rates higher for longer, inflation higher for longer, all of that together is going to be a headwind for the markets also. We think long-term, a lot of cash still on the sidelines. So I don't think the bull market's over, but short-term, you do need to be a little bit cautious. The two areas we like are technology stocks and dividend growers. Technology stocks still less correlated to economic growth, so I think they can have a rebound from here. And then dividend growers is an area of the market that's really underperformed year to date, and they tend to perform well in markets that are going down, so they have less downside capture. So those stocks, I think, are cheap and could protect portfolios and provide income.
Sarah, what you just said is actually incredibly controversial today. It might not have been controversial 2 weeks ago, but today, basically, you're going against everything that everyone is saying at a time when you have tech going down to such a degree and leading the declines. So how is tech defensive at a time when they potentially could be interest rate sensitive and when they have exploded? The big seven magnificent stocks have absolutely driven everything we've seen so far in terms of gains in the U.S. equity market.
Well, let's start with semiconductors, which is an area that we like. September tends to be their seasonally worst month in terms of performance, so not surprised to see that. They peaked out in about July, but if you look at the tailwinds for semis and software, which is our two favorite areas of technology, first of all, artificial intelligence, we don't think that it's hype. It's a real trend. It did get a little bit crowded, but I think it'll last for many years. Second, inflation has been increasing because of energy prices, which we think will moderate after the huge upswing that we've seen, and then continued services spending, which has been around for a while. That continues to moderate, another tailwind for technology stocks. And interest rates, we see the Fed basically one and done from here. One more rate hike. What got priced out of the market next year was 2 rate cuts. We didn't expect rate cuts for 2024, but as the Fed pauses again, I think these are all positives for tech stocks. So a few of these headwinds that have come in the last 2 months, as the sector did get crowded, will move out of the way. Also, looking at portfolio managers, they generally were underweight some of these mega cap tech stocks coming into this year. So you could see a lot of people stepping in for catching up to get their weighting in their portfolios to the right level. And then clients are holding still about 25% of their portfolios in cash. That at some point needs to come back into the markets.
Does it, though? I mean, this is sort of the key question. Does it, if you're earning 5% on it? Actually, maybe it looks pretty good. And there's a question about whether we've actually seen the effects of rates that are now the highest going back more than a decade, 2007, 2006, depending on which denomination you look at. Are you saying that these are rates that we can live at? That basically we have seen the effects and they haven't been too bad?
Yeah, I think what clients learned this year was there was an opportunity cost for holding cash, especially when inflation is at the levels that it was, and the markets have done what they've done, year to date. Even though they've moderated a bit in the last couple of months, markets are still up well above cash year to date. So there's an opportunity cost for holding onto that cash. So I think clients are figuring that out. And when it comes to high interest rates, the 10-year at over 4% is a headwind for the markets, but it all depends on what economic growth does. And if economic growth stays strong, I think the markets can handle a 10-year that's at these levels.
Sarah, this discussion on technology is so absolutely critical. A huge body of retail has taken the story if institutional is not. Now, the gloom is rates up. There's a duration argument about technology. I get it. Where in the income statement will you see tech superiority? Are they going to outperform on revenue growth, or do you go down where they surprise with a better marginal free cash flow?
The answer is all of the above, in the sense that the good news for software companies is they don't need to rely on pricing power. And as inflation does continue to moderate, which we think that it will, software companies are less affected by having to lower their prices and hold on to pricing power. Margins are important for tech stocks. We saw that with Meta this year, where they were ahead of the curve in terms of cutting costs and preserving their margins, and other companies have followed, which is important too. And then strong free cash flow growers. You look at Broadcom right now is a company that we like. Strong free cash flow, ability to buy it back up to like $9 billion in shares. VMware is going to add free cash flow to their model. So all of the above for these companies.
Lisa's buying a new iPhone today at Covent Garden. Sarah, should she be also acquiring Apple shares at the margin?
Apple is a company we've not been as bullish on for many reasons. Number one is the post-COVID normalization of their unit growth. I think is going to be an issue for them. And even with the upgrades of the iPhones, I'm a user of an iPhone myself, but upgrades have been pretty incremental recently, so they're not as exciting. I'm glad Lisa's excited about it, though. And also, their next big product is VR, which is a very high price point. So I think those could be struggles for Apple's, which has got premium multiple, as people have that's been a consensus holding for many investors.
I just want to set the record straight. And Tom, you know this. I am not a line waiter. I am not someone who's some sort of rabid enthusiast. I cracked my phone, so at some point I'm going to have to get a new phone.
They're going to be in Covent Garden lined up. They're going to be, oh my God, it's Lisa Abramowicz, surveillance. Can we do a selfie?
Let's move on. Sarah, I'm curious, though, just as we sort of take a look at the whole week, is 60-40 still profoundly challenged at a time where we're seeing bonds sell off at the same time in tandem with stocks?
It was challenged in 2022. I think 2023 has had a better return for the 60-40 portfolio, but it taught us a lesson about diversification and alternatives, an area we really like outside of the traditional 60-40 is private credit. It also tends to be resilient to an economic slowdown, and I think that's really important right now, is owning areas in your portfolio that are less susceptible to economic slowdowns, can continue to grow. I did also have one more question for all of you, though. You talked about Katy Perry. Are you in the Katy Perry camp or Taylor Swift?
Oh, well, I got to go with Katie, frankly. But I love what Taylor's been doing with the National. I mean, she and Antonoff, what they've done has been extraordinary. She's moving the needle on GDP. I mean, can Olivia go out there and move the same needle?
You're asking him.
I'm not engaging. That's all. Was that a question for Sarah or me?
No, it was for you.
All right.
You're going to try to just completely ignore it.
Sarah, she's ignoring me. It's Friday. Thank God.
Of Nuveen, wondering what on earth she's walked into. It took us about 2 hours and 10 minutes to ask a serious question this morning, and it was Bramo.
No, this was
does 60-40 work?
But this
60-40 work. Everybody sits down with a financial advisor. They walk into the room for people who don't know about investing, and they get told, "Do this." You ask them
You're
why.
100% correct.
They give you a reason.
I also disagree with
And then they look at your
mode.
portfolio,
Yeah.
and they're going to look at things right now, and they say, "But I thought you said that when this happens, and then this didn't happen yesterday at all."
Well,
Treasury's down, stocks down.
Yeah, but even over the last 18 months, if you look at the Bloomberg Total Return Index, 60-40 is tanked. And what's so important there is what Malik says of Nuveen is the zeitgeist of successful retail investing now. They bought 7 stocks as a generalization, and they're not selling them because they're the memory here. The memory back 3 years, 5 years, 10 years just says keep the apple, own it, and buy more.
That's enough. Give us another verse.
This
What have you got?
zeitgeist. No, I just, I mean, Lisa's out there. She's going to be over at Covent Garden, and she's going to get up and shake the glitter off her clothes. That's what you get for waking up in London. I mean, that's what Lisa's going to be doing.
Nice. That's good. We've got another 40 minutes of this, haven't we? 50 minutes?
It's Friday.
Can't wait.
We did the thing. What we do, we have a huge tradition, folks, where we pulled a strip, and Lisa won it. Lisa's going back in the Gulfstream.
Very cool.
Yeah.
She gets the plane. Yeah. Nice. If you're just tuning in, welcome to the programme. The S&P 500 positive here by 0.3%. Coming up shortly, in about 15 minutes from now, we'll catch up with Janet Henry of HSBC on the global growth backdrop. 3 big central bank decisions, no change at all 3, but there's one we've hardly talked about, and it's the BOJ. The BOJ just not really part of the conversation because they're looking at inflation in a completely different way, Lisa, compared to everybody else.
Because they're not saying anything. They're not saying what they want people to tell, like what they want people, what people want to hear, which is, when are you guys going to actually move? When are you going to recognize that data that you're actually looking at? And UAIDA is saying, we're not going to give that to you, so sorry, go home. And so we all are.
For them, it's not a problem, Tom. It is a solution to the issues they've had there for the last several decades.
I was honored, I kid you about tea. I was honored to take tea at the Bank of Japan a number of years ago, and it's from another time and place. This has nothing to do with modern monetary theory. The institutions are in place. They make the rules. These are the rules until.
Can I just say one thing in terms of clarifying all of the misspeaks that we've been having this morning? You say that I'm going to be on the Gulf Stream or whatever.
Well, it's a
and I just want to let you know something, that when we were coming home from Jackson Hole, the guy at the security counter said to me, "Why aren't you on the jet stream? Why aren't you on the Gulf Stream?"
Yeah.
And I was like,
Did you tell him that I had the G6? Did you explain?
I explained to him that you drew the straw.
No, I mean, to be honest, it's a little unfair.
To them.
Oh, obviously. You're right.
No, but
Come on.
in the old days, Francine hogged the thing. She had it nonstop, jetting around doing the leaders with Lacroix thing. But now, it's more fair. It's a more equitable distribution.
It's a more fair distribution.
Democratized.
Yeah, democratized.
Nice, nice. Communist, even, almost.
Don't talk to me on the break. Don't talk to me.
A little bit of strike fever is kind of coming to fruition right now. And when people get concessions, when labor unions get concessions, other industries, other labor unions say, wait, maybe we should do that too, or we can do that. It's not a frivolous decision, but it's a strategic decision.
Wendy Schiller of Brown University on the UAW strikes, the conflict, the tension between that union and Detroit's big three, Ford, GM, Stellantis. There is a new deadline for further progress, midday today, Eastern time. And if we don't see a sign of that further progress in the next couple of hours or so, we've got a Facebook Live, we calling this a press conference, Bramo? What are we calling this, an address?
What is it? Yeah.
Facebook Live address, taking place at 10 a.m. Eastern time with the UAW president. Going into all of that, this is how your day is set up going into the weekend. Let's get you to that weekend as quick as we possibly can. Your equity market on the S&P 500 positive here by 0.3%. That's a bounce from the biggest one-day loss going all the way back to March and all the banking difficulties that we had in the first couple of weeks of that month. In the bond market, I don't think the call was ever to see cycle highs after that tension, that those issues in the banking system in America back in spring, but to see cycle highs off the back of it 6 months later is phenomenal. We are pulling back a little bit. We're down 2 basis points on a 2-year to about 512, down 2 basis points also on a 10-year to 447. But to give you an idea, I don't know if you've been on vacation, hiding under a rock, in the last 24 hours, 2-year getting close to 520. 10-year in the Asian session going through 450, just stunning to see.
We do this every day where we're completely jaded by it. It's been sudden in the last 48 hours with the 10-year real yield out to 2.11%, I believe now 2.09. But John, you get off the plane in New York and what's the first thing you think about? What's a 30-year mortgage rate going to be? I mean,
pushing
does it
8%.
Go back out to new highs?
Pushing 8%.
Do you nudge up?
I think number one question we've asked is the right one. OK, that's the mortgage rate if you want us to go and get a mortgage right now.
Right.
How many people are going to get a mortgage right now? So you've got the price of money and then the price people are actually paying, given the agreements they've made over the last several years. So when do we start to see that great refinancing? Where in our future is it?
And again, it permeates for me down to a real yield and an inflation-adjusted yield. Let's remember 2.x% in the United States positive real yield affecting all, and the fiction of the United Kingdom where the real yield's still a massively negative statistic.
The unknown. Tons of uncertainty about the inflation story. But Tom, if they are seriously high for longer, if they're taking away all those cuts for next year, and if you're going to see inflation continue to make improvement, disinflation, then that real rate, Tom, gets even more destructive, doesn't it?
Absolutely. There's no question about it. And we can go to the residual math here, but that's going to be a huge theme into October. One of the themes we know is Keith Naughton and our team in Detroit will be glued on Facebook at 10 a.m., maybe to find out what modern UAW strategy is. If you're weaned on Walter Reuther, if you're weaned on George Meany of the AFL-CIO, it's a whole new world to provide wisdom with huge depth and perspective. Naughton of Detroit. Keith Naughton, I'm just going to cut to the chase. It's a whole new world after all. What have you learned about this new negotiation of 2023?
Well, it's really guerrilla tactics, Tom. They are taking out different plants at different times. They're trying to keep the companies off guard, keep the companies guessing. So yeah, what we will get today is UAW President Shawn Fain will announce the next round of strikes. They've already struck 3 plants, one at each company, as you know, and they're going to probably strike 3 more. The question is which plants they'll be. Will they take down the big pickup truck plants that provide most of the profits for the big 3?
Each of these companies has a different character. I think that's underplayed. We sort of amalgamate everybody into Detroit and their immense support of the Detroit Lions. Forget about it. Which company are you watching? Which culture in Detroit will give you signals about a successful outcome?
Yeah, I think the company that's in the lead is Ford. Ford has traditionally had the best relationship with the United Auto Workers. They've actually made 4 offers to the United Auto Workers so far. They were the first to give an offer. As you know, Bill Ford, the executive chairman, great-grandson of the founder, he showed up to make a proposal in person, their most recent proposal. Sean Fain stood him up.
Keith, what's the big holdup? Do we have a sense now? Is it really the salary? Is it the mix of products being manufactured? Is it the sense of guaranteed workers at a certain level at a certain number of plants?
Well, it's really all of those things. They are very far apart on wages. The union has come down from a 40% request to a 36%. And the best the companies have offered so far is a 20% from GM and Ford, 19.5% from Stellantis. So there's a very wide gulf on the wage demand. But yeah, they're hanging over these talks is the electric vehicle transition and the battery plants that all these automakers are building that are not yet organized by the UAW. The UAW wants to make sure those future battery workers will get the same wages and the same benefits as the existing UAW workers.
Keith, when you say that these sides are very far apart, you talk about the distance between the two, and I think about how inventories are going to start being bought down of some of the dealers, the auto manufacturers as well. How much do we expect auto prices to increase? How long does this have to go on before people feel it materially when they go buy a car?
Right now, inventory is pretty good. The automakers really built stocks in advance of this. So industry-wide, the day's supply is 58, and what's considered ideal is 60. So right now, there's a pretty good inventory situation. But the more plants come down and the longer this goes, then it starts hurting.
Keith, what's your timeline? The one thing I can't get out of experts, I mean, I got a lot of punditry and that, but you people are so informed. I mean, even Craig Trudell over here in London is somewhat in the game. What's the Bloomberg timeline, your best guesstimate of this strike?
Well, we've spoken to one analyst who thinks that it can run to the end of October. It's very hard to know. There's some stuff that came out overnight, some texts from union sources that it looks like they really want to make this go for a long time to inflict pain. So it doesn't feel like we're very close to a resolution.
So are we talking F-150 now, Tom? Are we going that far?
They're going to go to the emotion of pickup trucks, which is the lodestone for certainly. Well, I'm going to go all three as an amateur, but I defer to Keith on that. But
Keith, just to make it really simple, is that like the last thing that they reach for, or do you think that's the next thing?
It could be the next thing that they reach for. If they really want to inflict maximum pain, you take down the Ford F-150, the best-selling car in America since Ronald Reagan was president. You take down the Chevy Silverado, you take down the Ram pickup truck. Those are the cash cows for Detroit. Those will cause pain immediately.
Well, Keith, the big hang-up here is how much money they have left at the UAW to keep paying people who strike. I mean, are they going to try to use it up? Do they have a limited amount of time, or do they have a lot of runway?
Yeah, so they have $835 million in their strike fund, and they're paying $500 a week to strikers. But so far, there's only 12,700 strikers because of this targeted approach they're taking. That's how they can conserve money in the strike fund. However, the companies are laying off people because there's this ripple effect that happens when plants go down. And the union has agreed to pay those people getting laid off as a result of the strike from the strike fund as well. So that will deplete it faster.
Interesting. Keith, thanks for the update. Keith Norton there of Bloomberg, looking ahead to this Facebook Live event at 10 a.m. Eastern time, ahead of the supposed deadline of midday Eastern to make sufficient further progress. I sound like Chairman Powell over at the Federal Reserve, but we're looking for sufficient further progress in talks, Tom.
Well, you know, I'm glad you brought this up. And, John, the pickup truck thing is certainly very emotional, but I was thinking, you know, based on all my knowledge and heritage here, you know, I just think UAW, they really ought to go after the Pinto and the Javelin. I mean, that's really... You know,
do you want to explain what the Pinto and the Javelin is?
The Pinto and the Javelin to foreigners like you is when we started buying foreign automobiles. They were so bad. They were so poorly designed. There was also something called a Suzanne Vega. A Vega. There was a Pinto.
You can't say he's a foreigner in the UK when we're in London. You can't say that.
No, do that when I'm in America.
I know, exactly.
No, but
I mean, it's like you
the
can't
bottom
do it
line.
either.
No, but seriously, when did we start buying foreign automobiles and why? It was because Detroit invented and engineered these monstrosities. They were all glass. They weighed a ton. They couldn't go around the corner.
The thirst for bigger cars.
And we said we want to buy a Renault. We called it a Renault, I think then, and a Puget, and the rest of them.
Say that again. Say that again, the last one. The French
the
brand.
Puget. It was a Renault. You bought a Renault Dauphine. The rich kids' fathers had a Renault Dauphine.
Did they?
And the rich art students, the art chicks, they had a BMW 2002
How much of this have I got to get
something.
through? Another 30 minutes, something like that. You're going to stick with us at home, I hope so.
Yeah.
Janet Henry of HSBC is going to join us shortly. Sima Shah a little bit after that. All of that in the final 30 minutes of whatever this is. Live from London. This is Bloomberg. He never stopped, for what it's worth. There was a break of about 3-4 minutes, but the conversation continued, and I'm still none the wiser. If you are just tuning in, congratulations. Your equity market on the S&P 500, positive hit by 0.4%. Session highs on the Nasdaq as well, up by 0.7, a lift off the back of the biggest one-day drop going back 6 months to the month of March. In the bond market, cycle highs, a 2-year, a 10-year, a 2-year earlier this week pushing 520, backing away this morning, down about 3 basis points. But to see a 30-year in the 450s, a 10-year in the 440s, and briefly overnight in the Asian session, a 10-year at 450 is just absolutely phenomenal. The Fed might be signalling maybe they're done hiking, but it's going to be at this level for perhaps a whole lot longer, based on the way we've internalized that message in this bond market, Tom, this week.
George Saravelis gave us a window. He published literally in the last 30 minutes their outlook into the end of the year, and every shop has to do that. How do you publish an outlook with yields moving like this? You got to go, what if higher? What if lower? What if disinflationary trends click in?
Well, you had a dummy run from the Federal Reserve. How did that go on Wednesday? They published an outlook.
I'm in your camp.
Then got a bucket of freezing cold water and just did that all over it and said, yeah, about that, no.
To me, I just think that there is one logical conclusion that we can have, and I feel like people are kind of dancing around this, which is that no one in the U.S. is paying the rates that are exactly being quoted,
the transmission's
except
different.
for the U.S. government. That is it, right? Basically, the new bonds that are being issued, and even then, only on the margins. So how can we really say that we've seen the effects of this, right? But then how do we say that we are ever going to see the effects until 10 years later when all of these bonds mature, et cetera? So at a certain point, isn't this an economy that's just completely immune to rates and are going to have to go a lot higher than people previously thought? I mean, why is that not
we'll work through it.
part
So
of the discussion?
For corporations in the next year, high yield, we know there's a maturity wall out there.
Right.
They'll have to pay it. If you wanted to buy a new car right now and you weren't paying cash, you'll have to pay it. It's just taking longer than I think we thought it was going to take, particularly when it comes to the mortgage market. Housing, I think housing's just its own beast. 30-year fixed, you're holding on to that 2% mortgage, you're not letting go, are you? So that's its own beast right there. But other parts of the economy, they'll feel it over time. Whether you need to wait or go further is part of the conversation. I think we're going into this quarter where we're hearing the same old story. That's the problem I've got with this fourth quarter. The fourth quarter, it's the economists that cried recession, and no one believes them anymore.
Right.
So now we're stacking up a whole new load of issues. Student loan repayments, headwinds coming from energy, et cetera, and no one's buying it anymore. No one's buying it anymore at all.
People believe in the strength, and that's why we're seeing yields get to such highs, even though everyone was saying, buy the long end, it's going to definitely go lower and go back to something more normal.
5 days into this sojourn in London, and after our great credit conference, we haven't even talked about Jim Zeltner on fire yesterday.
Yeah. He's fantastic.
At the credit conference. I was like, you guys were going with him as bond people, and I was like actually listening to the state of the industry, which I never think about, but very, very cool. Thanks for the comments on that. The Julianic Memorial Credit Conference that we did there, I thought that was very good yesterday. We needed a voice near the end of our sojourn to provide balance and a view forward. There's no one in London that can do that like Janet Henry, global chief economist for the Hong Kong and Shanghai Banking Corporation, wired into Asia, literally like no one we talk to. You've got a lovely view. And then there's China. What does HSBC, with all of your contacts, say about the stability and the economic recovery of China?
HSBC has a perhaps more balanced view of China than some of the hysteria that hit the markets not so long ago. I think we're not going to get any quick answers one way or the other on China, and we need to learn to live with that. You know, financial markets always want to know with certainty where things are going to be in 2 years' time, and they want to price it today. The fact is, in China, what we have seen recently is some signs of stabilization in the economy. Industrial production showed some improvement, retail sales showed some improvement, credit data is showing some improvement. Are there still major challenges in the property sector? Yes, and we are seeing a gradual rollout of policy stimulus that is now being reflected in monetary data. Are there major issues in local government debt stocks? Yes, there are, but are they providing liquidity? Yes, this is a multi-year story of ongoing stabilisation, and the next round will be structural reforms to deliver the long-promised higher quality of growth.
On monthly, on 3-month annualized, and within your research note, we see a disinflationary tinge. That dovetails with Steve Major's long-term conviction of price up, yield down. That's been tested the last 72 hours. Do you guys stand with a disinflationary tendency which filters in to lower yield?
Well, from a macroeconomic perspective, for the last 2 years, Tom, as you know, I've been talking about a deterioration in the growth-inflation trade-off, a different mix of lower growth, higher inflation, and that probably requires a different policy rate level than we were used to in a pre-pandemic era. Yes, we have some disinflation, but there are plenty of risks out there. Even the Fed's Goldilocks view that they set out at the FOMC, the level of uncertainty around that they are admitting is quite high. But by the same token, it's not so long, as you've already highlighted, that everyone was forecasting a recession. First half of last year, this year, second half of this year, now a soft landing. The fact is, this is an unusual cycle. The last 3 years were unusual. Why does the market keep fitting with the idea that this is going to be a very ordinary downturn with a very ordinary Fed response?
Has something changed, Janet, from your perspective, the relationship between the labour market and price pressure, just based on those forecasts? And Chairman Powell himself hesitant to ascribe a narrative to a median projection, but let's have that conversation anyway. We have done over the last couple of days. They're essentially saying we can get inflation down to 2% with unemployment not climbing much above 4%. What do we learn from that?
We've learned that they are extrapolating what's happened so far.
Right now?
Yes. So you're right. I mean, it's remarkable. We've never been in the recession camp. We've been in the more protracted slowdown, the rolling recession camp, a couple of years of sub-trend kind of growth. But now the Fed has overtaken us on the unemployment rate. You know, we only had unemployment at 4% by the end of the year, but we've got it 4.5% by the end of next year. The Fed hasn't even got that, having previously said that it was going to rise by more. It has been extraordinary that wage growth has gone from nearly 6 to just over 4, but the recent progress has actually been a bit slower. And everyone's talking about the strike. We don't know. It could be that actually there are other areas of the economy where, because of collectivised wage bargaining in Europe, because of public sector pay in the UK, because of strikes in the US, that it's not a linear story. Actually, it's a bit rocky on the way down, and the disinflationary process, as we've discussed before, is not continuous. We've got other areas of inflation volatility, and the markets are going to have to accept that they really are willing to keep interest rates higher for longer.
For people who go on the Federal Reserve website and they open up the summary of economic projections, should they view them as forecasts or aspirations? What are they?
They should view them, obviously, that every central bank, given their inflation targets, their inflation priorities, that is their primary goal, and they will do what is required to get there. Obviously, what we got in the Fed projections, and to some extent we've got in other central bank projections as well, is that they're almost willing to take a little bit longer to get there. The Fed is saying it's not going to be at target till 2026. And they have said that their central scenario is now that they can get there by being a bit slower, a bit more patient about getting there. They can get there without a traditional recession when the economy has some kind of deep contraction. But as no one ever reads to page 2, page 4, question 4, question 5, what's your certainty about this range of forecasts? It's still very high. It's not where it was during the pandemic, but it's still high.
Are you basically saying that what we're seeing this week in markets is a sea change about our understanding of central banks' patience with such high inflation, that they will tolerate it for quite a bit longer, and that means it will become more entrenched in a way that people previously had not expected?
I'm not saying they will tolerate it staying at these levels, and they certainly will not tolerate any signs that it's reigniting, whether that's from wage pressures or elsewhere. They need to see further progress. They need to be confident that that progress is going to continue. And obviously financial markets, at the first sign that maybe a central bank is done, is celebrating the fact that the next move is going to be downwards. And actually, the more that financial markets do that, the more likely it is that a central bank that's trying to tighten financial conditions actually stops raising rates. So I think that what they're telling us is that they are determined to drive it lower. They might be patient about the timeline with which they get there, but they're not going to take any risk that it becomes entrenched. You had that from the Bundesbank again overnight.
The game theory that you just laid out, does that mean that the yields that we're seeing now are finally self-fulfilling and will actually create or foster the tight credit conditions that are necessary to get to the Fed's and the other central bank's goals? I mean, in other words, do you think that these are sustainable, or do you think that this is what we need to get lower?
I think how financial markets react, obviously I'm just the macroeconomist, will be a function of what central banks obviously do. But the central bank is trying to tighten financial conditions. It's trying to slow demand. They still think by slowing demand, they can impact on inflation and ensure that the inflation continues to slow. But we keep talking about all of the uncertainties that are still out there. We've got a renewed inflation volatility, not least from oil and from food. We've still got uncertainties regarding labour markets. The truth is they don't know what they're going to have to do, which is why, as well as saying we're ready to raise rates higher, we're ready to keep them on hold for a very, very long time, it's actually all still about the data dependency. So, yes, they're still watching all of these factors as long as they can see progress, whether it's a consequence of higher yields, whether it's a consequence of what's happening in equity markets, whether it's a consequence of what's happening in spending behaviour. As long as they see the inflation data coming down, that will be enough to become more confident about the medium term.
I have to ask this question. It's with immense respect for what HSBC and like Bloomberg went through with COVID. I mean, we've heard from the quarantines of HSBC and the travels during COVID in China. You walk out of the Bloomberg building in Hong Kong, you go across that historic tramway, and there's one Queen's Center, your building, your place. It's the foundation of Hong Kong finance. What's the stereotype right now we most get wrong about the new Hong Kong?
That is a very broad question.
Well, it's a Friday, so we go with broad questions.
It is a Friday. Yeah. But actually, you know, as an economist, I always think that sometimes we think about countries. You know, obviously as an economist, I love it that people want to talk about countries. They want to talk about central banks. But a lot of the things that happen, whether it is in Hong Kong, whether it's in Dubai, whether it's in London, whether it's in New York, is actually more about sectors and it's more about companies. So whatever view you have regarding the macro story, when we're thinking about where the true transformational shifts lie in the coming years, and a lot of it is in technology, there is still a lot of dynamism and there's still money being provided to companies.
I'm going to make some news here.
That.
10 seconds. Are you a Hong Kong
trying to cause
optimist?
some trouble? That's what you're trying to do.
Am I a Hong Kong?
Are you a Hong Kong
Absolutely.
optimist?
As someone that lived in Hong Kong for 5 years, I'm still a Hong Kong optimist.
Are you done on that subject?
I think it's important. I think HSBC, Steve Major,
agreed.
Janet Henry, these people have a prism in there. You know, all the stereotype blather we deal with. Our Steve Engel.
Since we're causing trouble, I miss David Bloom. I miss David Bloom.
Yeah,
so
well, he's trouble.
He was great.
You know,
he was trouble too.
He's trouble.
Janet Henry, thank you. Of HSBC. Appreciate it. It's good to
Fabulous.
see you. If you are just tuning in, welcome to the programme. Equities right now positive by 0.4%. Yields a little bit lower by 3 basis points to 446.81 on a 10-year. Seema Shah of Principal Asset Management is coming up very shortly, Bramo, to round out our week in London before you head off to New York.
It's been quite a week, I have to say.
What's your big takeaway?
My big takeaway is that people are pricing in higher for longer, and people are pricing in this idea that it's going to take a lot longer to get inflation under control, and that suddenly there's a question about what that does to the fundamentals underpinning the market. If rates really are higher, suddenly you get those tighter financial conditions that weren't there earlier when people were just expecting the Fed and all the others to cut.
Which I'm listening to people pushing away from that, like Janet Henry and Ms. Malik over at Nuveen. She was starkly opposed to that cautious outcome, starkly opposed.
It was the first time, I think, in the last couple of days where we've started to see those high yields hit risk. I checked high yield spreads this morning. At least they're a little bit wider.
Exactly, that's
given what's happened in the bond market, because they haven't been at all. They're still sub 400 for what it's worth, still pretty tight. on a historical basis. Equities right now positive by 0.4% on the S&P 500. To wrap up our week in London next with Seema Shah of Principal Asset Management. Live from the city, this is Bloomberg.
My feet are firmly on the ground. We've played 5 games and we've started off well, but it's how you end that counts.
The mood around the club seems to have changed. Big Ange, has he changed that?
He's had a very, very big impact. We wanted a manager that we need to go back in time to our real DNA, and we needed somebody that understood that, you know what, there's no easy fix to win. We're very much a club that believes in the academy, producing players that can become hopefully superstars at Tottenham. We're not a club that can buy success. That's the reality, and we have to understand that. And we needed a manager that was completely aligned with our philosophy.
A better mood around Tottenham Football Club going into the North London derby this Sunday. That was Daniel Levy, the Tottenham chairman, talking about the impact of the new manager and the impact that manager has had at the club this season ahead of Sunday's derby against Arsenal. You can watch the full interview with Daniel Levy on Bloomberg's YouTube page and at Bloomberg.com. TK, that's out
play
there
it down.
right now.
Come on, this thing went worldwide, folks. For those of you that don't follow this foolishness, this is the most substantive interview in English football in ages and ages. I looked at one German website which tore about, John, your work, and also 2 other outside sources on the future of Mr. Keene and when he comes back to the United Kingdom. What I don't get is Daniel Levy, with no government funding, with a lot of bank loans, built a palace. He described to you the free cash flow, and he's sitting there crying poor that he needs an academy to build the team. I don't buy it for a minute. Is he one of the rich guys like the Saudis and the rest of them, the Qataris, or is he as poor as he let out?
I wouldn't use the word poor, that's for sure, but I wouldn't use the word rich or as rich as the likes of Saudi Arabia. And compete with sovereign nations is really difficult. The beauty of the stadium that Tottenham have built is it's multi-purpose. So the pitch can go away, then you can have a music concert. The gate receipts, he was talking about the numbers, north of 100 million sterling. That's just for football. Another 30 million.
So Katy Perry can go in and go if it's hot.
Beyonce,
and it's cold,
she might want to
you
sing
know.
that. Let's see if that sells out. I don't know if it will or not, Tom, but ultimately, yes, and they can raise more money doing that. It's made the club, as far as he's concerned, a lot more sustainable financially and put it on a really good path. The question now is whether he is open to a stake sale. He says he is.
Yes.
He says, like he always says, I've had a duty, as always, to lead the club for the best interest of the stakeholders and the fans for that matter. And if they get an offer, you just get a sense, that openness, Tom, that conversation. A lot of people reading between the lines and thinking that maybe this is a moment where he might be a little bit more open than he has been in the past.
Because of the impact of this interview, 2 quick questions. Is he looking for a minority sale, a stake sale of 10%?
Unclear, don't know.
Or is he talking about sale of the franchise?
Unclear, don't know.
What would they go for?
All I do know at this point is there is huge demand in British football. And we've seen takeover after a takeover happen, particularly from the United States. What would a number? I can't throw a number out there. I can say that the Glazers wanted something close to 7-8 billion for Manchester United. They weren't getting the number they wanted.
Okay.
Could it be close to 3, 4, 5?
But it's closer to London, and they have the derby. Okay. Well, who's your next interview with?
There's a list.
There's a list?
We've got to nail down the Glazers. So a lot of people giving me feedback to get the Glazers.
Look
We've got
Jim
to get
Selnick, and it's a
Todd
Rochester
Bowley,
interview.
Get Todd Bowley out of Chelsea. Try and make that happen too.
Okay. Well, congratulations.
And the leadership over in Newcastle. Let's
huge
do that.
impact. And look for David Hillier and all of our English football coverage with Bloomberg News. Right now, Seema's going, is this what I showed up for? Seema Shah's with his Chief Global Strategist, Principal Asset Management, as we finish strong in our week in London. What have you learned of the last 72 hours of central bank football? What's the summary for the Principal Group?
That the conclusion of the London derby is clearer than what the central banks are speaking about.
Do you have tickets? Excuse me, guys. Do you have tickets for the derby?
I don't.
Continue.
No, look, I think the central banks don't really know what's going on. They're really confounded. We've heard from everyone that actually Powell is a little bit confused. As he talked through the conference, The questions, actually, he gave very, very unclear answers, I think. It was quite confusing.
Shah in the same territory as Ferro.
So what's your takeaway? I mean, right now what the takeaway has been from the market is that higher for longer. That seems to be the theme. Do you push back? Do you think that we're finally seeing rates at levels that will actually be restrictive enough to bring inflation much lower and to actually create some weakness?
So I don't think rates need to go any further than where they are today. Because I still, we talk about the lags continuously. I think at some point the lags are going to come in. Timing is difficult to call, but they will come through. And then if you do another hike, you are risking a bit of an error. So that's what I think. I think, for the higher for longer, it makes sense in light of the kind of 1970s experience, which inevitably is going to be very fresh in their minds. And that probably is what keeps them from cutting rates a little bit longer than maybe they should do. So we're pushing it out to probably the second half of 2024 for the first rate cut because of that concern. What could happen to inflation?
Just taking a step back, are you more pessimistic on risk or less pessimistic on risk after what we saw over the past week?
I'm actually nowhere on this one, which is unusual. It's extraordinary. But the reason is, I'll explain why. So I think that the market is really going to be very range bound through the first half of next year because there is no very, very clear narrative. If you have high growth, then you have higher interest rates, so it's offset. If you have low growth, it's offset by interest rate cuts. So until you get to a point in the second half of the year where you do get an economic downturn, but then it becomes quite clear that the economic downturn is shallow, and then that's combined with rate cuts, that's when I think when the market can really rally with some conviction.
I've heard 28 flavors of equity belief and conviction into 2024 on this trip. You're writing an outlook now to get to Q4 before your, painful 70-page 12/31/23 outlook. What's your conviction on equities?
That they're range bound. That is a clear conviction. If I look across, I think that the US is going to outperform Europe, certainly the United Kingdom. So there is still an element of US exceptionalism. I think that the large cap space is going to be challenged, but I want to be a long-term investor in that.
So you want to capture
space.
Dividend growth? I mean, just as simple as that.
Yeah, I think that is what it is. We're thinking about income at the moment. That, I think, is the one thing that we can have a little bit of conviction on.
Preferred shares? How's 60s of me? We're talking Pinto and Javelin. Preferred shares?
Well, the interesting thing about preferreds is that, they were beaten up earlier this year. A lot of investors, even as actually the bonds came back, investors felt like they'd been permanently damaged by the events, and they lost conviction. But you've actually seen everything start to creep back. So I think preferreds could be on a decent rally.
I love, I love preferreds and warrants. It's great. I feel like I'm in England. I'm in London. It's railways to India.
Seema, just let's end on this note. That as you take a look at your caution from earlier in the year, and the fact that everyone who was cautious ended up having real regret and then saying, okay, well, we shouldn't be too cautious and we can't predict recession. Does that make you fearful of doing the same thing again? Has that sort of been a bit of shell shock that you feel across the street right now?
I think so. I think everyone is confounded by what's happened with the economy. They're confounded by central banks. And inevitably, as you try and switch your calls, you're worried that, oh gosh, everything that I thought is going to start coming through. So you have to have a view on the fundamentals. And for us, the fundamentals I still believe in the lags of monetary policy. I think it will come through, but I think it's going to take a little bit longer.
Seema, this was great. It's good to see you in London. Thanks for being here. Seema Shah of Principal Asset Management. Tom, we've got 2 more minutes left. Have you found more songs?
I teared up. Henry emailed in. Thank you, Henry, for watching. The surveillance team's interviews this morning from London with Stubbs, Rochester, Malik, and Shah have been worth more than the cost of a month's cable TV subscription.
Very cool.
The benefits of your London week-long relocation have been invigorating. See ya in late November.
Is that your ghost account, or is that real?
No, that's real.
That's real.
I mean, I just think.
Believe that.
I've got no idea.
After Thanksgiving, in time for holiday shopping, you can do another interview with Daniel Levy.
Okay. Let's watch this interview. Daniel Levy, catch the full interview if you can over the weekend on YouTube, on our YouTube page or on Bloomberg.com. Look out for that. On Monday, very cool conversation coming up on Monday. Permacrisis, the latest book with Mohammed Al-Arian, Gordon Brown, and Michael Spence, all three together, Tom, a conversation about their latest publication.
Fascinating, and particularly with the former Prime Minister, to see what Gordon Brown says about New Labour, about their dynamic, how they respond to what the Conservatives are doing.
There's so much to talk about. Also, that title, in and of itself, Permacrisis. Bramo.
Doesn't sound like Michael Spence.
I'm looking your way, Bramo. This is your kind of book.
I mean, this is the whole thing, is that we've been going from crisis to crisis, people planning for crisis, and now we didn't get a crisis, and now people don't know what to do with themselves. If we're not getting a crisis, what are we having right now?
The laureate,
I'm so confused.
The laureate Spence is going to push against permacrisis. He is, optimist.
It's going to be very cool. This was great, guys.
This is great. Thanks to our team.
Thanks for coming back to home turf for a little bit. Back to New York.
Hot brown water was great.
Okay, I'm pleased you didn't insult too many people, Tom.
Thank you.
Just a few. We'll leave it there. Let's try and get TK on a plane and out of London unscathed. From the City of London, thank you for being with us all week. Thanks for the hard work of the team, the producers, for everyone who's put this week together for us. We appreciate it. Live from the city. Good morning.